This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. So today I had planned a monologue based on a series of emails that I exchanged with this random stranger that wrote me. That's coming because this guy was just pure cult inspiration, like Scientology cult level. He's convinced that he can make 1% per day. Not bad, huh? Now, the best trader in the world, Jim Simons, is what, at 66% a year before his fees? 66% a year, and this guy wants to make 1% per day. Convinced it's possible. So I'm toying with the idea of a monologue that allows his words and my responses to intertwine. Because it's not just that he's not informed or obtuse or whatever. It's the whole psychology of watching the interplay, watching the interaction. And we can all learn from that. But today I want to jump into a mega episode with some traders from my prior episodes. 4 very classic names that most people in the markets will recognize. If they don't, they got Wikipedia pages that you can consult with really quick. First, trader Larry Williams. Second, trader Toby Crable. Third, trader Ewan Kirk. And fourth, a trader, Leo Melamed, but more known as a pioneer in financial futures at the Chicago Mercantile Exchange. These 4 guys, Larry Williams, Toby Crable, Ewan Kirk, Leo Melamed, they think wisely. They have insights. Whether you are new to my podcast, and if that's the case, you have to listen, or if you have been listening all along, these are the refreshers that you need. Without any further delay from me, without any more rambling around to tell you what's coming, let me just roll and send you into 4 of my best episodes. Today on the show, I have Larry Williams. Larry is a trader and Larry is an author. Larry has been in the trading game for a long time, over 4 decades. His name is very well known in almost all trading circles. I hope you enjoy this conversation. Hey, Larry, how are you?
Pretty good. You're in Singapore? Where are you?
I'm in Saigon today.
In Saigon? Oh, my gosh. One place I've never been. I always wanted to go there.
Where are you right
Virgin
now?
Islands. Virgin Islands.
You sound FM radio good, considering we're probably about 8,000 miles away.
It's amazing, isn't it?
It really is. It really is. Hey, listen, I want to jump right in because as I was preparing for this interview, I do all my Larry Williams homework, searches, and all this kind of stuff. And the headlines that dominate in the last at least couple years are really about the title of your most recent book. I wonder if you might address that, because what's interesting about those headlines, these IRS headlines that you faced, is that it's really the beginning of the story and the headlines don't reflect the end of the story.
Yeah, that's true, isn't it?
And I think the really interesting thing, and I'll let you expand on this too, is that, and I've not had a chance to read this book, and you can expand on it as much as you want. I think I'm going to go read it for sure. But the idea that when you had gone through this whole process, you ultimately said, and I'm paraphrasing, I can only put so much blame at the feet of the IRS. It's really about Congress. Is that a paraphrase or is that close?
Since the book has come out, what we now know is the IRS has targeted specific peoples and groups. And I was indicted and we'd been in touch with the IRS for years, trying to work everything out. I was indicted the week that my daughter was up for an Academy Award, the Academy Awards week. And I was a great poster child within the industry. The fact that I was in Australia and she and Heath Ledger were a couple. And I had been in the United States before. Why was I indicted in Australia? You know, I could never figure that out. But now, when retrospect and knowing that the IRS has been a rogue agency for a long time period, some pieces of the puzzle fit together better now. So do they target people? Sure. Was I high visibility with an industry? Yeah. Is it an industry they want to scare? Yes. So I was a great target. I was a poster child. So so whose responsibility? And ultimately, we should have a different tax system, and that's Congress's position. The IRS just enforces. But the way the IRS enforces things leaves one to question their reality.
You raise a great point, and I think everybody in the audience knows that there has been targeting, and I think it's a matter of public record. You raise a really good point.
Yeah, and clearly, in my case, I followed the advice of some lawyers and CPAs who were pushing the edge of the envelope, but they were Price Waterhouse guys and, lawyers, and they said, do this and you'll be okay, and I did that. And assuming for a moment the IRS was correct in their view and I was wrong, there's no mens rea. I was doing what professionals told me to do to minimize my tax obligation. But the IRS would never listen to that viewpoint in negotiations prior to going to trial. Never, ever, ever. It was only, do you want 6 years in prison or do you want 3 years in prison? What type of deal do you want to cut? And I said, I'm not going to cut a deal. I'll go down swinging one way or the other. And eventually, of course, when all the charges were dropped, every single charge was dropped, they finally had a realization in trial that they couldn't win the case. And so on the third day of trial, they said we could see them texting back and forth to Washington, D.C. It was actually kind of funny. And then they wanted to recess, and they made an offer, and we talked and came back with it, and eventually said, okay, this is what we'll do. But yeah, their unwillingness to negotiate with me, well, they were with other people, I think just reinforces the targeting aspect.
Yeah. I mentioned to you in email, and I've not talked about this in my podcast, but I had a case in Virginia that went on for nearly 5 years. And in hindsight, it's very difficult when you really know you're doing the right thing, you really know the government is overreaching. And so I relate to the idea, and I'm sure many people, unless they've gone down this path to standing up to the government, you can't really truly imagine what it feels like to take a, quote, good fight forward, or to try and do the right thing, or to have not done anything wrong, and then to be on the other side of a behemoth that has unlimited spending power. Even at the local government level, they can hire whatever attorneys they want, and they pay whatever bills they want. It's amazing.
Yeah, somebody estimated they spent about $6 million on it. We spent maybe $2 million in my defense. And I've taken one case all the way to the Supreme Court of the United States, which we won. We took one all the way to the Supreme Court of Australia. We won at the High Court and lost on a split decision at their Supreme Court. People don't realize, I think, two things: enormous cost, and as you pointed out, the time. These things go on and on and on, and it just drags on your psyche. They just don't sense that, and the government will send out all sorts of news releases. We've indicted so-and-so, what a bad guy is. But after all charges were dropped, the government has yet to do a news announcement saying that we dropped all the charges. They refuse to do it.
Right there is the most telling example, and I'm not putting words in your mouth, but to me, it's the most telling example that it is personal. Because if it's the government and it's objective, if they want to announce the charges, then they should be willing to do the exact opposite when they're wrong. And when they don't, it tells you it's personal. And when the government's personal, that's scary to me.
Yeah, it is. We tried to not make it personal against the fellow who was prosecuting us, but either he had directions or he did take it personally. I don't know, but it's you can get destroyed in the media, and then everyone forgets about it, and so that's the story. But when you're victorious, that story never comes out. And that's really the responsibility of good journalists.
Well, the book is called Confessions of a Radical Tax Protester. So for those folks that want to check it out. And for those folks that are tuning in and expecting us to jump right into trading, I frankly, like I said, doing my research here today, I wanted to make sure I kind of discussed this right out of the gate because it did make a lot of headlines. And I did notice that your daughter's name got tossed into it. And that's kind of, it's unsavory, right?
Yeah, but it's what is.
Yeah, it is. It is.
This is America. This is what they do.
Yeah.
You have to learn that's how the game is played.
Yeah.
And you have to have a strategy to deal with that, an emotional strategy as well as a legal strategy.
Yeah, well, you seem pretty calm, cool, and collective about it. I might have had more of a meltdown.
Well, I think years of trading helped.
So listen, let me jump in, and I want to go back to your very beginnings because I announced to my Facebook that I was going to be speaking with you, and it is interesting. Your name, you have so many people that when they hear your name, they are just interested. They want to hear what you have to say, and they get excited. And I'm still a novice to some degree. I'm a newbie when it comes to Larry Williams, but I want to jump in and let you go back to the very beginning. And I've seen you give some comments about this before, but I want to let you discuss how you even decided to approach trading and what were your motivations?
Well, it began in 1962. I was looking at a newspaper and I saw that a stock was up 0.1 or plus one. Had no idea what that meant. I come from a working class family. We never owned stocks. And so I said to a friend of mine, what does that mean? And he said, well, if you would have bought that stock yesterday and got out today, it would have made $100. And back in 1962, that's probably like $3,000 today. And I go, wow, this is for me. You can just guess something goes up and make money. That's really attracted me. So it was just pure. I'd seen my dad work real hard in an oil refinery all his life. And he always said, learn to work with your head, not your back, like in his hands, like he has. And I thought, wow, this is interesting. You just make money looking at a newspaper. And of course, I thought it would be easy. And of course, I've come to find that that's not correct at all. But that was just pure greed, what first interested me in it.
Let me take even a step back further. You grew up in Montana, right?
That's correct.
So I've not had a chance to visit Montana, but and I think people hear Big Sky and they know it's a massive state. How did growing up in a state like Montana, which is a state of resourcefulness, a state where you probably have to take care of yourself a tad bit more than growing up in a big city. There's a lot more that you have to be aware of and take care of. It's the life in being I don't want to say the country, but just a more rural growing up. How did growing up in Montana affect you personally?
Well, I think first of all, that's probably the most insightful question I've been asked in any interview. I've never been asked that before, but I have cogitated on a bit. And I think two things. First of all, as I see kids growing up in a big city, it's hard to be really creative because your mind doesn't just flow in the mountains and the streams and hiking. And I think you can get much more creative growing up because you learn to create stuff in the environment and see it change. So I think that's been very helpful to me. And the other thing is that everybody in Montana is hardworking people, or at least it was back then. And you really treasure money and hard work and a work ethic that says, I used to ride rodeo, and you're going to get bucked off, and it's going to hurt, but still you get on, and hopefully you can hang on, and you're going to win. It's kind of like in the markets, really. You're going to get bucked off, but if you stay on, you win some money. And you pay to ride rodeo, and you get bucked off, you don't get anything. And it's kind of like the market as well. So I think there was that general idea of entrepreneurship, though my father worked for a large oil refinery all his life. My grandfather had a grocery store, and maybe I got the entrepreneurship from him. But just the idea in Montana, it's not only the Big Sky country or the treasure state, but it's big thinking country. You just, it's amazing the people that have come from Montana, the things they've done, in part because I think they have that very open mind about, hey, I can do whatever I want to do.
Well, and you've done that. I mean, back in the 1970s, I believe you were the Republican nominee for Senate. Was it 2 elections?
2 elections. I lost to Senator Baucus, who went on to be head of the Finance Committee, and Senator Melcher. And unfortunately, I chose to run against incumbents, which is really a tough position, but occasionally they get knocked off. It was a great opportunity to.
I know I'm bouncing around here a little bit, but you've got such a varied background, so you have to excuse me. How did I mean, look, here we start the podcast talking about this most recent issue that you had this battle going on, but politics is the ultimate battle in the government. So here you are running. How did you decide to put your name in the hat ultimately? I mean, what were you thinking to yourself and say, I'm going to run for Senate? What was going on in your head? What did you want to get across to the people? What did you think you could do better than the guys that were out there?
Well, in terms of the Republican primary, I actually called the chosen guy who was running for the Senate, and I said, "Hey, Bill, I'd like to know where you are in your positions on a couple of issues. Maybe I could help you." He said, "Well, I have a committee that will tell me my positions on the issues," and that just turned my stomach. I thought, "What? You don't know your own positions?" That kind of was a triggering agent. And then, be really honest, one night my buddy and I were driving in Montana back from someplace. And we stopped and had a couple of beers, and about 5 beers later, he figured out that I should run for the U.S. Senate, and I was too dumb to disagree with him. It was really all about less government. It's the same issues today. Nothing's changed. We should probably have balanced budgets. We should probably have less government. We talk about that we may run out of money for Social Security, but we never talk about running out of money for welfare checks. But like this whole system's out of balance. I had seen too much government interactions with the SEC and CFTC and in my business. So I figured, hey, you know what? Montana's got some problems. I understand futures, future price, wheat, cattle, oats. So I felt that I could represent the average voter better than the other guy. And that's what got me in the office running.
So a quick story about me. When I was 21 years of age, I was living about 15 miles outside Washington, D.C. in a small town in Virginia. Today, one of the wealthiest counties in the country based on the numbers of federal employees living there. But when I was 21, I actually ran for mayor of the community I live in against a guy who was 72. And I have to tell you, putting myself in the spotlight at such a young age to be involved in politics, and it was a serious type thing, that changes you. You either continue with it or you say, you know what, I've had enough. I'm going to go do something else with my life. And I said I had enough.
Yeah, I can certainly relate with that. I think there's a point where if you're heavily involved in the political process, I was a regional director for John Connolly's presidential campaign, worked on Ronald Reagan's campaign and Jack Kemp's. I mean, he did a lot of Iowa primaries and stuff. And after a while, you kind of say, you know what, enough. It's like in boxing, protect yourself at all times. I got to protect myself, get out of the ring here, make certain these guys, don't continue to screw up my life. And that's one reason why I'm in the Virgin Islands. It's great tax structure here, a lot of freedom here. We're part of America, but yet it's different than America.
Yeah. Well, let's jump back into trading. This is what most people want to hear. They want to hear your insights. And I want to go back to some of the beginnings and maybe let you elaborate on a word that I love. And it's often a word that is, how do I say this nicely, bastardized in common parlance, but the word speculate. To speculate is an awesome endeavor, in my humble opinion. How do you feel about it?
Well, yeah, and if we go back to the Latin root for the word is specular, which is to see, like glasses, spectacles, right? And the difference between a speculator and a gambler is we observe things and make certain references and then determine what the future should be. So we're not gamblers. We're actually making observations, and based on those observations, we're correct or we're not correct. And it's interesting. The other day, somebody was saying, "Oh, you speculators drive up energy prices," and they're all upset about speculators. Okay, I don't think they do. But if they do, what about when energy prices collapsed a couple of years ago? Do speculators get credit for that?
Hey, don't ask the obvious question. Don't ask the obvious question.
Yeah, they only look at it one way, and they don't really realize that if we didn't have speculators, markets would be much wilder than they are.
Yeah. So why don't you continue on this thinking? So you're in Montana, you're a young man, you're wrapping your idea around trading, you're seeing starting in stocks. How did you make the migration to thinking about commodity futures? I mean, I naturally, I think, and I've talked to Salem Abraham, who's a trader out of Texas, about this, growing up around cattle and whatnot. I think it's a little bit different than kids that might grow up in the city. You actually see and understand some of the mechanisms for the buying and selling of animals at a young age.
Well, I understood math. A broker told me that I could get, without having to pay interest on a margin account, I could control $30,000 of pork bellies for $500, or I could buy $500 of stock. Where do I get my biggest bang for my buck? And once I had that realization, I thought, well, the future is a lot more attractive in terms of what your potential is on the upside, and of course, on the downside as well. But that was the really switch point, was just the economics of it, that I got a much better deal, and that there's real demand and supply for corn and wheat and gold, and there is no real supply or demand for IBM or Apple or Google. I mean, you really don't need a share of Google. You can live the rest of your life without it. But you can't live the rest of your life without wheat and sugar and coffee and corn and gold and silver and all these things. So we have real data about those markets, real fundamental data that we don't have in the stock market. There's no true demand for them.
How did you start to put the pieces together, though? Because for the average trader, for the new trader, even for the established trader that's out there, there's a lot of different factors going on. So you have the emotions of it all. People just getting excited. They flip on CNBC and there's 6 suits jumping up and down, and you start jumping up and down, and you call your broker. But then there's the issue that you brought up with the leverage inherent in commodity futures. If you don't have risk management, if you don't have a money management strategy, you can end up in a bad place fairly quickly. So how did you start to put the pieces together about the emotional part of it, the money management part of it? I'll let you continue there.
Well, I guess I was lucky. There was no CNBC when I started. So you didn't have all those things pulling at you. I really just got into the first book I read was Joe Granville's book. And later on, Joe, who unfortunately passed away a month ago, became a friend of mine, both he and Karen. His book was very inspirational about, there was logic to this business called stock trading, but it was all technical. And I traded as a technical only guy for probably almost the first 10 years. And then I met a guy, Bill Meehan, who had been a member of the Board of Trade, who was really into the fundamental aspect and taught me the fundamental aspects of markets. And we came together, 2 guys, Keith and Kevin Campbell, who run one of the largest funds now in the world out of Baltimore, had been a friend of Bill. And it's really interesting. Bill was the inspiration for a lot of guys. And what I got from Bill was that markets get set up for big trend moves. Technical stuff will call all the trends, but you get whipsawed to death. So what you want to do is put a trend mechanism on top of a fundamental conditional setup market. Then trend isn't just hoping that one of these things goes up. As a speculator, you're observing that this time, this trend change should be better than just a 20-day average crossing a 10-day average or whatever. So that was the total perspective Bill gave me, the conditions set up markets for trend moves. And his problem, why he came to me, why we worked together, he had no clue about technical stuff, timing. Technicals are all about timing, but you don't know if it's going to be a massive move. You don't know the magnitude of the move. Just because you get above a 50-day high, it doesn't mean you won't go right back down. But if the fundamental conditions are there, then the trend change is much more sustainable.
I have to admit fully, and I think you probably know this about me, I am not a fundamental guy, and I can't add any value there. I can appreciate that there are definitely people on this planet, and I think you've had some experience there for sure, who have been able to pull it together. I know Ray Dalio, and I sometimes want to know what his secret sauce is, but Ray Dalio swears, I don't know if he swears, but he says that he trades only using fundamentals, but trades them systematically, which was intriguing to me.
Well, when we were roommates together many years ago in New York City, I think he scoffed a little bit at my technical stuff, and I scoffed a little bit at his fundamental. It wasn't until years later, that I haven't even seen Ray since somewhere in the 70s, that it was really interesting. We both pop up again with a little different trading style, but clearly I think fundamentals are the basis for the magnitude of moves. And I know students of mine who now manage money have taken my work. This is exactly what they've done, what we've always talked about. They'll take a turtle channel breakout, but only if there's a conditional entry there. And of course, then you don't have to wait for, say, a 20-day high or a 50-day high, because if the conditions are there and they're ripe for a significant move to the upside, then you can buy at a shorter time period high or moving average or whatever your technique is, because the stage is set for a big up or a big down move based on the fundamental conditions of the marketplace. I don't disagree with trend following. I think it just has to be used selective. I don't disagree with using a hammer, except you got to find the right place to use a hammer.
Yeah, there are different approaches. I think sometimes what I do, and people get into debates with me, I've enjoyed being in the trend following world because there was so much data to observe as a young man coming into it, I could see all this data and observe it. On the flip side, if I picked up Seth Klarman's Margin of Safety as a young man with a political science background in my early 20s, that was a much more difficult proposition for me to wrap my arms around.
Well, margin of safety, I think that's one of the incredible learning experiences that I went through, and that maybe every trader eventually has to face. And that is the risk control aspect of this. It doesn't matter if you've got the greatest system in the world. If you don't learn how to control and bet size and manage your account, you really have to manage the markets, your trades, you have to manage your equity, and you have to manage your emotions. You've got to really touch on those three legs if you're going to be a successful trader.
Well, I brought those up a second ago. So why don't I let you expand on the phrase money management? Because even though people have heard it, it's not something that resonates with a large segment of the population. Many people, you could take a doctor, an attorney, a young man out of college. It's a subject that's still, you've been at this for a long time. It's a subject that's still in the weeds. It's still hidden away. The idea of money management, bet sizing, position sizing, however one wants to call it.
Well, I'll make it real exciting here. I took the $10,000 to $1.1 million in a real-time trading championship because of money management. My daughter, when she was 16, took $10,000 to $110,000 real dollars in a trading championship. And a lot of my students have done this similar thing or comparable. Nobody's got our records yet, but they're trying, and they do really well. And it is, sure, they're decent traders, maybe even good traders, great traders, but it's the money management that gets the exponential growth of the account. But that sort of has two sides to it. And really, to simplify it, it's that trend is the basis of all profits. No trend, you're not going to make a nickel. But trend is a function of time. So the time you're in the trade, it gives you more opportunity for trend, which is why day traders have the deck stacked against them. Time runs out at the end of every day. They cannot catch a big move. So they have to bet large to make a lot of money. My game is to bet small, and if I lose, then I can only lose small. Whereas if I catch a trend move, I can catch a substantial profit because I have time in my favor. So your time frame is part of your risk management. And the overall underwriting rule is really bet small to win big. You have to bet a correct amount based on your system. But even at that, as I mentioned earlier, if your emotions don't allow you to handle a $50,000 loss and you're trading $1 million account, whatever, if your emotions don't let you handle that, you can't make that size of a bet. It isn't just the math of it. You've got to actually have an emotional quotient on what risk you can emotionally handle, and then strive to find where that optimal F is that Ralph Vince has written about.
Yeah, Ralph was on the show. Ralph is a really interesting guy. I'd love to meet him in person. He was awesome.
He's the smartest guy I've ever met. I've met a lot of brilliant people. I don't know if you're aware of, you've probably read Ralph's books. Ralph never took a class in math.
Yeah, it's amazing.
That's all self-learned. He's an amazing man, just a great guy. Just had a lot of good times together.
Let me keep going on the money management though, because I think let's phrase it this way. I've done this before at an event, you tell people, you say, listen, okay, you got $100,000. How much are you going to bet on each trade? And I've asked a room of 100 people this before. And it's amazing, the numbers. You've got people that raise their hand and say, I'm going to bet $10,000 on each trade. They only got $100,000. They're going to bet $10,000 on each trade.
Well, if your emotion can handle it, and I would precede it with that, the maximum bet that I would make would be a 4% risk or $4,000 potential risk in the trade. I think that is the optimal number, all things considered, for most all traders. Probably a 2% is more manageable. And people think, well, I can never make much money with a 2% risk. A couple of years ago, when in Australia, I started a $100,000 account. A year later, it's a little over $1 million. And it was on 2% risk bets. Probably most were 1% risk bets. So you don't have to bet big to win big if you're catching large moves in the marketplace. I think optimally, and I can show mathematically why 4% is about as heavy of a bet as you want to make. Or as a risk, not a bet, but a risk. That's how much, if I'm wrong, I'm going to lose 4% of my account.
And you would consider 4% on the heavy side.
Pardon?
You would consider 4% to the heaviest end that you would go.
Yeah, to the heavy side. And here's why. it's not uncommon for me to have 3 or 4 losing trades in a row. So if I have 4 losing trades in a row at 4%, I'm down about 16, 20% of my money with slippage and whatever. And so that's frequently happens in everybody's systems or everybody's trading approaches. So I have to be willing to have an equity drawdown I can live through, not sit through, but actually live emotionally through that. And a 4% risk that's pretty gutsy.
Why don't you talk about the emotions? Because you just said it, living emotionally through it. Somebody's listening and maybe they think they know what you're saying, but do they really know what you're saying? Is it it's the waking up in the morning? Is it you're thinking about it too much? And I'm not saying you, I'm just saying the wrong way to do it, that you're thinking about it during the day. Talk about that, the emotions of it all.
Well, I have a lot of experience in doing the wrong things in the markets, so I'm real qualified to speak on this one. The other things I don't know, but I've done a lot of wrong things in the markets. And I think the underlying thing is the human brain is wired to be right at all costs. So we get into arguments because we want to prove we're right. People kill people on freeways because somebody cut in front of them. So we'll be dead right, literally. We just have to be right. And in the markets, you can't be all right all the times. And you have to learn to accept that. And if you can't accept that, you get really frustrated and very angry about the markets and that you're losing, you're not making money. The guy next door, your brother-in-law, is making more money. And it's just, it isn't just the size of the loss. It's the fact that you're losing, and maybe 2, 3, 4 times in a row you lose. And that makes you think you're a loser. And you get in all sorts of emotional traps. I don't know if you're aware, my son's a psychiatrist trained at Johns Hopkins and did an interview with 20 major traders, big-time traders, names you know. And the takeaway from his in-depth personality profiles of all these people is, he's the first person to just interview successful traders. None of these successful traders have really big egos. They're not overly confident people. And that was one of the most important takeaways to me, is that we have this impression that traders are gunslingers and they're totally confident, and those are the losing traders. The winning traders don't have a great deal of inner confidence, and that's why they control risk so much better than guys who think that the God's gift to the markets.
I feel very fortunate to have sat down, talked with, become friends with, shared experiences with some men that have so much market success that their kids, maybe 500 years from now will still be living off the residual. And you're right. Most every one of those people that I've had a chance to be around, names that people would know, they put their pants on exactly the same way. And they just act down to earth. They've had a system, they've had an approach. Maybe there's been a little luck on their side, but they've grinded it out, and they've been at the right place at the right time, and things have taken off. But I find they're just down to earth, very down to earth.
Yeah, you look at a guy like Steve Cohen, who's just, you wouldn't have any idea this is a billionaire, 4 or 5 billionaire type guy, done 30% a year for 30 years in the marketplace, and he doesn't have that persona that the movies have made out, or somebody like Paul Tudor Jones, Ray Dalio. And these guys are pretty much salt of the earth people. And understanding that, I think, helps us to become better traders, to see what the personality profile of winning traders is. Another interesting thing that Jason's book pointed out, his research showed, is that all of these really successful traders found a strategy that fit them. So some are fundamental, some are technical, some don't want a system. Some, if you gave a system to, they could never follow it. But they're really good traders on their own, using their own discretionary ideas in the marketplace. And they had to come to that notion. Some went from going to systems to discretionary. Some went from discretionary, realizing that they had to be a system trader. Your personality dictates largely the approach that you should be using in the marketplace. And too often people say, oh, Larry Williams, I'll just follow his stuff, or I'll just get the turtle trading system, or whatever, not realizing, does that fit you? You really have to answer that question.
And that's a good question, too. What is the definition of fit? And I think that not as much research as your son, perhaps, but some of my casual observations is that most of these men they said, well, Is this a good opportunity? What's the science behind it? Let's stick with it. Let's execute it. Let's run it like a business. Let's have a profit center. Let's run it like a business. And I think that seems to be a common thread that I've seen in so many of the traders that I've had a chance to sit down with, learn, and interview from.
Well, and I think the ones that you've interviewed, which are legendary traders, they are different than guys like me. They are so much smarter because they're not only great traders, but they put together business enterprises. I'm basically a writer. I have my degree in journalism that turned trader. And these guys are business guys that have put together organizations of thousands of employees underneath them, managing billions of dollars. So not only are they great traders, they are brilliant, absolutely brilliant business people. And there's a real difference between just the trader and somebody who can make a business out of the art of trading. I mean, I have so much respect for these people. They are just so far ahead of most of us in terms of just the intellectual qualities of their life. Oh, my gosh. Amazing.
Taking on the responsibility of losing money for other people is not easy.
Not fun.
No, that's not fun at all. Hey, listen, let me shift gears on you a little bit more too. So the idea of markets changing or the conditions in markets changing, I think many times people, maybe new traders, they approach the markets and they get caught up on this word change. So let me ask you, big picture wise, how much has really changed about the condition of markets since you got started to today?
A lot has changed, but it's technical change. It's change in how long it takes news to get disseminated. I'd get the Wall Street Journal 3 days late. The content and the delivery time period of news took much longer. Now it's instantaneous. So that's one thing to deal with. But the big change really is, we've gone to electronic markets. I made fortunes off the opening gap from the day close to the next day's open. And because we had a time period of, 10 hours, 12 hours where nothing was happening, well, we don't have that gap anymore. So I had to seriously alter a lot of my trading styles because I didn't have that opportunity to take advantage of anymore. So that's a huge, huge change in terms of my trading. But I still think supply and demand drives the markets, and the technical emotions are really technical, I think, measures emotions. The wiggles and waves as we go from point A to point B are technical. The overall trend from A to B is fundamental. And those emotions are still the same. As you know, we can go in any country in the world and look at their markets, and they just look like the markets here, except maybe China because you can't sell short. But the same patterns are there that we see in our market. So these aren't chart patterns. These are patterns of emotion. And we're all humans. We all have fear, greed. Doesn't matter what your culture is. So that stays the same. How we trade markets, we're all electronic. There's a lot more traders now, so they're a little more emotional. That's a change, but not the core fundamentals. Those haven't changed.
Let me shift gears on you again. Since you've seen everything, so I'm just going to keep asking questions. So in the last couple of years, and I had a hedge fund buddy of mine call me recently, and he was having a conversation with a fund manager friend of his, and they were talking about volumes in Chicago, and they were talking about MF Global, and they were talking about a VIX, at least until the last month or so, has been non-existent. And they were also talking about London. And they were talking about funds, big U.S. funds moving offshore, and Dodd-Frank and QE. So is there something structurally going on that maybe has kind of come out of the two-headed monster of MF Global and current QE policy that is possibly changing the structure or the trust in the markets, the commodity markets that you've known since you're a young man?
Yeah, the trust is, I think, the big thing. The EDF Man fiasco, and then Russ Wassendorf, that's another great fiasco where the regulatory people won't take responsibility for not regulating who they should have. A lot of people are going, the commodities are as risky as I was told they were. And so I think we've dried up some of that. There's been some shrinkage, but there's been this whole expansion of the Forex or FX market. And that actually concerns me a great deal because so many Forex people are saying you can open an account with a credit card. You only need $200 to trade. and will give you 100-to-1 margin. I have more respect for people selling crack cocaine on a street corner than somebody's going to give you 100-to-1 margin. And it's ridiculous. 100-to-1 margin, you're going to lose all your money at some point. It's just a question of time, this day or tomorrow.
And so we have IRS agents chasing you down, but the 100-to-1 FX margin guys, as long as I can remember, have been promoting that as a legitimate investing type opportunity, and the regulators just stare in other directions, I guess.
Yeah, well, and I think they've changed it now. You can only offer 50-to-1 or something like that, but it's all ridiculous. Like, oh my gosh, and your commission is higher there than it is in the Globex or the ICE. So, but it's all a promotional thing, and I guess that's another thing that never changes. You always have these guys out there. You always have humans are greedy and want to make a lot of money, and you have guys who will pander to that, whether it's internet marketing or whether it's Forex or commodity trading or stock investing. There's always somebody there to indicate maybe you can make money quickly. You can raise red worms in your backyard and sell them to fishermen. But there's always somebody with a deal for you.
Indicators, something that is near and dear to you, and many indicators with your name affixed to them. I think a lot of people starting out in the markets, when they first learn of technical analysis or trend type trading, they see these indicators, they get excited. And once they get what it is, and then the next thing you know, you've got a chart that looks like hieroglyphics on there. There's so many things going on that it's just destined to not work, but they don't necessarily see that. Why don't you talk about the idea of KISS, keeping it simple, stupid, so to speak?
Well, I think it's really important that because all these indicators are really redundant. For the most part, if you look at the Bollinger Bands percentage or Williams percent R or RSI or stochastic, they all look almost exactly the same. I've done presentations on this. There's not an ounce of bit of difference worth between them. Yet guys will have all these indicators or gals on their screens, and they're just redundant. And they are actually redundant of price because they're based on price. When I took logic in college, my professor, Albert Castell, said you cannot predict A with A. You have to use B, C, or D to predict A, but we're using price to predict price. And there are some aspects of price maybe we can look at that are helpful, but there's so many indicators that you don't know what to say. So I think you need to break down your indicators into a couple categories: the fundamental ones, the emotional ones, and the trend ones. And then whittle those down to as few of those as possible. Then you have a sensible approach. I only, on my charts, I have 3-4 indicators on my charts. That's it.
Yeah, I think for some new traders starting out, that might seem foreign, but I think it's good for them to hear simplicity.
Well, there's no perfect indicator. I mean, I've got some really great indicators, and they don't work a lot of the times.
Yeah,
they work often enough, but you just because somebody, as you know, people will show indicators in books. And in an uptrending market, all this stuff works, but markets don't always trend, and they never show in the books the bad aspects of this stuff. So everything looks perfect, and then you start trading it, and you run into reality that actually a divergence in an oscillator may be very bullish, but the books say it's very bearish. So you got to be so careful. As Ronald Reagan said, trust but verify.
Yes, and I actually he said that in regards to Gorbachev, did he not?
Yes, yeah, in Russia, yeah.
I had a chance to meet Gorbachev once. That was interesting.
Oh, how cool!
Yeah. Well, let me. I want to kind of wind down with you and maybe talk a little bit, because I want to get some of your perspective, big picture. Look, we're going to go ahead and give your website address and where everybody can reach out to you. But I think ultimately, some of the most important aspects of being a trader, an entrepreneur, somebody that just wants to get ahead, there's just certain personal ways that make a lot of sense to be. And I know clearly by your bio, you've been a fighter. You've definitely fought fights. I'm curious, when you look back in hindsight, do you regret any of your fights, or do you feel like those fights shaped you and gave you wisdom today by going through those experiences?
Oh, I'm certain there's one or two I would regret. I can't recall them. But I think that the temperament of the Montana idea, if you're right, you stand up for it. And if you get beat up, so what? You stood up for what you believed in. And I think that actually helps in trading, because you're willing to take a position. A namby-pamby guy who will run from a fight won't take a position in the market. Paul Tudor Jones was a boxer. So many of these traders have been in an aggressive form of something along the way. Charlie DeFrancesco, the largest bond trader in the history of the world, was a great football player. I was a mediocre football player in college. He was great. And I think that aggressiveness maybe, or that willing to take a position, not aggressiveness, willing to say, yeah, I'm in, I think is actually helpful to trading. That's how I see it, at least.
Well, you mentioned earlier, and I didn't get a chance, I didn't follow up on it, but you mentioned the idea of Montana and the bucking bronco. And I was thinking to the big city kid, or frankly, even worse, the suburban kid, the suburban fast food kid. But here you grow up in Montana, the idea of a bucking bronco, by its very nature, is you are going to get tossed off, and you're actually you're judged by getting back on. And I think in a society these days where every headline is, or it seems like a lot of headlines are banning dodgeball. I saw a headline the other day, a little kid apparently, and I'm not condoning any kind of violence, but I did this as a kid. All little boys do this. He held up his hand. He made like a gun symbol. He was like 7 years old, and they suspended him for school for a year. And I think there is I think there's a neutering of society going on, Larry. That's frankly frightening. Like what is happening to us that we think everything is supposed to go in a straight line, and everybody is wearing like some kind of padded suit, and there could be no injury. Doesn't injury teach us something?
Yeah, I couldn't agree more with that. That we've tried to have this pasteurized, homogenized society where everybody knows what's best for us. And even if they're right, we never really learn it on our own. I mean, you can read something in a book, but until you experience it, you don't really know it. So, yeah, to get tossed off a horse or get tossed off a bike or a car or do stupid things as I did, as I'm certain you did, as we all do, that was a phenomenal learning experience. And we don't get that much anymore because we're protected. That's a societal change that we're trying to transition through on part of some political people, and the other people are resisting it. That the best learning is from your experience. And certainly Michael Bloomberg saying you can't have a large Slurpee. I mean, come on, Michael. That people will actually rebel at that and have more of them, or they'll order 2 or 3 large Cokes instead of where they would have just had one. So, yeah, it's sad to see. And I think that may be why more people are coming into trading. I've seen really 2 interesting things. People do want some place where there is some exposure to risk and opportunity. And it used to be when I lectured on commodities around America in, say, the 60s and the 70s, it was all middle-aged white male. And about 1980, that started to change, and the people coming in were younger, some female, still not very many, and a lot of first-generation Americans from Germany, from Italy, from India, from Mexico. Suddenly there was a shift. The risk takers in America were no longer Americans. They were first-generation new Americans. They were the ones that wanted to risk. And that really just was a real wake-up call, like, wow, the people that want to risk are the new generation, not the old generation. You still see a lot of that.
Yeah. You were mentioning about silly things in the youth, and I was just recalling that one of my favorite experiences growing up, I was probably 19, was waking up the next morning and having 2 black eyes, not one, but having 2. And that actually, I don't know how many guys can actually say they woke up and had 2, which means I didn't win, but I learned a lot. And I did hurt one guy in the bottom of the pile. But and I was just on a really kind of more simple level. I should tell you about crossing the street in Saigon. So it's a city of 10 million people. There's 5 million motorbikes. When you cross the street in Saigon, you look left, you look right. You look left, you look straight. You look right, you look left again. You look right. You don't ever stop looking. The risk doesn't stop. And I think that's kind of what you're getting at, is that maybe there's a desire for people kind of, there's a certain segment of the population realizes that frankly, the nanny state is not fun. It's not fun to be put into a padded uniform.
Yeah, all gray is not a pretty color. Sounds like a great place to raise commodity traders. You got to look and be aware of that much.
Look, and I've mentioned this on some of my other podcasts. I was speaking earlier this spring in mainland China, and I have to tell you, sometimes people think that Westerners will say about the Chinese, their religion is money. I can report with firsthand experience, the mainland Chinese tell you that their religion is money. They don't beat around. I mean, they say we are going for it.
Yeah, it's certainly changed. I was first in China in the late 1970s, and everybody that was there wanted me to bring them home to America. And now, when I go to China, I've had 3 or 4 books in Chinese. They want to buy a house from me and have me come live there. I spoke at their Stanford unit, their comparable Stanford lecture there. It's totally changed now that it's opened up, and they really are about making money, which really means they want more freedom, because that's what money buys you ultimately, is freedom, nicer lifestyle, freedom to live a nicer lifestyle. And they really want that, and they are working so hard for it.
Yeah.
Amazing opportunities there.
I remember walking down the street this spring, and I passed a basketball court, outdoor court, and there was a bunch of young guys, probably 17 to 22, playing hoops. And I mean, these guys were 6'1", 6'4", all wearing sweatpants, running around dunking. And I was thinking to myself, I don't think a lot of Americans realize that they're handing out milk and meat here these days. And I would tell the Chinese, I said, I said, you guys remind me a lot, and some of these speeches, you remind me a lot of Americans, because in America, American likes to everyone to say, hey, we're number one. Well, I'll tell you what, the Chinese view themselves as number one too. And anybody that thinks that it's just an American playing field and it's not global today, I don't know how to convince you.
Well, yeah, that's a great point. It has become more global. And I think in part because America, part of our leadership is backed away from wanting to be number one. We don't want to be number one. We certainly don't have a policy of that anymore. It's, well, we have to be fair to everybody, and we've been colonialist all these years, and we shouldn't be number one. Like, what a stupid attitude. I mean, I don't care if you're Taiwanese or you're a Singaporean or an Indian, your country should be number one for you. You have a right to earn that position. And for some reason, so many people here have just backed off from that.
Yeah, it's interesting. It's interesting that we're talking today with some of your political background, and I caught some this morning that they were having the great political debates in D.C. about debt ceilings and whatnot. And let me end up with that. Let me let you kind of describe, if you're willing, how do you see, and I think your politics these days is mostly libertarian. Is that correct?
Very correct.
So if you were to give advice to somebody, and because look, I know that if I say the word libertarian, which is where I kind of think of myself, most people will kind of in America give you kind of a slanted eye, like, well, what's that? And still, but why do you consider yourself libertarian, and what are the advantages for you philosophically? How did you get to that point? I know I've covered a lot of ground today, Larry, but you got a lot of experiences. I'm sorry I'm going everywhere.
No, that's fine. It's made it enjoyable. I got to that point because I was tired of seeing politics of either persuasion having a Band-Aid philosophy. Oh, there's a problem, we'll put this Band-Aid on, which is usually more money. But there was no thinking or theory behind why these things were done. Libertarians, whether you agree with them or not, they are consistent in their approach to government. I've known Ron Paul for 35 years. His views today are the same views he had 35 years ago. He is consistent. And I may or may not agree with him on everything, but I know exactly what I'm getting with him. I don't know exactly what I'm getting with most Republicans and most Democrats, because they're all over the board. It's whatever panders to people that are going to vote for them or give them money. That's the driving force of their political theory. And I really like to see some consistency in government, and how we need government. We need it to do certain functions, and it just needs to be done on a consistent basis. So we understand the limitations of government, as we've talked about earlier, and the greatness of government. And I think that's what libertarians offer, is consistency. Might disagree with them, but you know where they're going to stand on the issues.
Yeah, I couldn't agree more. Hey, Larry, where can the audience, and obviously the audience is going to already know where to find you, but where is the best place for them to go connect with you? Your website, your Twitter, Facebook, where do you want people to best be directed?
Well, at 71 years of age, I don't want any more friends. I'm trying to lose some of the ones I have right now. So I have no Twitter.
You don't, hold on. Does that mean you don't want anyone showing up at the Virgin Islands, knocking your door and saying they're going to take you to lunch? You don't want any of that?
We've had that happen. But the best place is our website, ireallytrade.com, because even as an old man, I still really trade. So ireallytrade.com, there's a lot of stuff there, a lot of free stuff. And we're not much into marketing anymore, but that's the best place to reach me.
Okay. Well, how is the? Well, I've been to St. Thomas, but
I can see it across off my out of my window. I can see St. Thomas today.
How's the weather today?
The weather's beautiful. We kind of live in perpetual summer. The tax code here is so great. If you qualify, your state, federal, and local tax is 4%. It's actually 3.9. We call it 4%. So there's a lot of traders that have moved here, publishers that moved here, a lot of software companies, because 4% state and federal tax is a heck of an advantage. So it's an interesting community.
Yeah, I was down a couple years ago speaking with some guys that had set up shop down there. Yeah, it's definitely interesting. Well, listen, Larry, it was great. I appreciate you coming on today and offering all kinds of perspective.
Well, I am honored to be on your show, Michael. Thank you so very much for having me.
Well, I appreciate it. Look, people, I think it helps so many people to hear. I mean, they can always hear me rambling on about whatever, but I think when they hear different perspectives, people that have led interesting lives, people that have taken chances, take risks, it can only help other people to say, hey, hold on, I don't have to just sit in an office cube for my whole life. I can go do something. And so I think you've definitely done a lot of different experiences, and I hope people learn from that.
I hope so too. And that is a wonderful thing about trading, is the lifestyle that it can create. If you want to make a big business out of it, like some of the guys we've mentioned, or you want to be like I am, kind of a free spirit, do a bunch of crazy things, you can do that. It leaves the canvas wide open for you to paint the picture, because you have control of your life as a successful trader, not a boss, not a company.
Yeah. Larry, once again, thank you. And hopefully we will talk again on the podcast.
I look forward to that. Thanks very much.
Coming now after Larry Williams, my second episode in this mega episode. That sounds kind of silly, doesn't it? My second episode in this mega episode. I'm using the word episode too much. Next, Toby Crable. I first reached out to my guest today in 2005. It just struck me, and we talk about it in our conversation. 9 years ago. Damn, time flies. Toby Crable is my guest today. Crable Capital Management. Short-term systematic trader, quant. Very different than most of my world. Now, a lot of commonalities. Price action driven, systems, models, risk management. But Toby is working on a whole different time frame, turning his portfolio over typically in less than a day. But I still remember our first meeting. It was a great conversation. And what struck me about Toby was his philosophical nature. The competitive sports side, a former pro tennis player, but that philosophical nature, and then executing it in the systematic trading world. I thought it was such a unique story, then and today. I hope you enjoyed this conversation. Toby, Mike Covel.
Hi, Mike. How are you?
Man, it's been a long time. I think it could be 9 years since we spoke.
I think that's right. I think it was in the Virgin Islands, right?
Yeah, I was like, wow, where's time go? That's really scary.
It's a bit frightening.
Right. I just hope they figure out this life extension soon before we leave. So.
Yeah. Interview Ray Kurzweil. I think he's after it. So.
Yeah. So how's it going?
It's okay. I keep working at it and improving a little bit incrementally. And those little gains help so that the firm's going well, my family's good, and we fully moved out from Wisconsin. And it's a good life, playing a lot of tennis, and there's a lot of good things happening here.
Let me jump into the setup of tennis, but first I want to describe a few big picture points. I want to drive right into what you just mentioned. So the head of Covel Capital, over $1 billion assets under management. Since 1992, your track record starts, but not an overnight success story. And I just checked on Amazon today to look at your book, Day Trading with Short-Term Price Patterns, priced at $981 for a new copy.
But a little low.
So, but here's where I want to go though. Before all of this, pro tennis player, I think you got as high as 280, or as low, I should say, 280 in the world. Talk to me about though that experience of being such a competitive tennis player. The 8 hours a day for years practicing. Is there a direct translation to the competitive drive that you have in the asset management field, the fund management field?
I think a direct translation, actually. I mean, I refer to it all the time as it's an analogy for what I'm doing in my business and the way I approach things. So, especially in those early years of the track record, but it can be a good training ground if you take away from it the idea that we can always get better and we can improve at what we're doing. And the one thing that's very clear is there's losing days, and there's losing trades, and there's losing tennis matches, and how that's handled and what you take away from it is the most important thing. So that's I think for me is the key to longevity, and the solace that I haven't always done that very well. I mean, in tennis, I think I stopped a little early. I had looking at the record, I had a lot more potential than I gave myself credit for. So one of the things I take away from that first career is that I'm not going to quit. So that's why. I mean, there's been some tough times in these markets and in my own business, and I just don't. First of all, I don't want to destroy anything that I have by having too big a drawdown. So we're very conservative with risk, and I think that permeates the firm. And then secondly, when you're there to fight for another day, you don't let yourself get overwhelmed by the tough times, the losses. The day-to-day grind of it. Try to elevate a little bit and keep my head about me when it comes to that.
I'm guessing from a tennis analogy, if we're going to stay there for just a moment, you would probably prefer the consistency of a track record. If I pull up Wikipedia and I look at Federer versus a Nadal. Nadal is fantastic, but he doesn't have, best that I can tell, the consistency is Federer's in a completely different league.
Yeah, I truly do admire, of course, both players, but Federer's it's incredible talent. But the way he plays, there's a conservation there of energy, I think, that will allow him to play, I think, probably we'll see a lot longer than a lot of players. And there were others like that in the history of the game. I mean, Ken Rosewall played into his 40s and did very, very well. It doesn't happen as much anymore, but I can think of Pancho Gonzalez was in his 40s when I think he did very well at Wimbledon one year. So I mean, if you're, I don't know if it's pacing yourself, but Nadal's passion is fantastic. You have to love the intensity that he brings to the game, and there's really something really important about that when you see it. But yeah, I mean, when I think of my careers, especially this one, I'm thinking lifelong. This is something that I really enjoy, and I'm just fascinated by markets and price movement and how to quantify that. It's my science. It's what I do. And there's hardly, I mean, you can train in other sciences and that'll help, but it's you got to really get in there and work with the market data and use your imagination. So yeah, this is a lifelong pursuit. Mike, and I think that I don't think I'd have it any other way. I'm not going anywhere.
Let me drive into this. So I want to break apart some trading aspects and details of how you approach the markets philosophically, et cetera. But I know when we talked years ago, you really thought that your space, and we had a nice long conversation comparing your style of trading to trend following, some of the quant trend following, and there were some commonalities, but your time frame was very different. And you painted a picture that you were in a pretty unique space, that you were very humble about it, but you were saying it was very difficult to compete with your strategies. Whereas there definitely are, many more trend following traders out there, and still to this day. So I'm curious, do you still feel like you have this unique space, your firm, and its multiple strategies?
I think so in the money management world, handling client capital. I think it is unique because most of the shops I think our evolution is we're moving shorter, and our holding periods are tending to be shorter. So with that lends itself to there's only so much in the way of assets that you can manage, and there's a demand for it if you're good at it. So you have to be careful. And what happens is I think there's some very good proprietary firms that have evolved into relatively short-term trading like us or shorter. And the high-frequency firms are certainly an example of this. I think that they're primarily or almost exclusively high-frequency are prop firms. So they're using their own money and investing that and instead of trading client capital. And it's understandable because of the capacity constraints that exist in the short-term area. But yes, it is unique because it's certainly in the money management field, there aren't a lot of us. What we do is we're trading primarily liquid instruments. We're a liquid product for clients. We trade frequently. We're less than 1 day, and our holding period on average is a lot of turnover in the portfolio. It costs a lot. It costs a lot to run the business. There's huge challenges in the execution area. So we really, it's not an area that I think is just not that because of how it's prohibitive with the cost. It's just an expensive proposition. So there's not a lot of people that are going into this. So, but I came by it honestly. I worked with a floor trader in the early '80s. And we had a joint account. In his account, he paid no commission. So I was led by the nose to be trading and to take profits intraday. That just stuck with me over the years. That's just what appealed to me after doing that. You're kind of hooked. So yeah, it is a unique area in the money management field for sure. There's plenty of prop firms though that do this. And those are our true competitors, I think, when we think of where we're at on the planet. It's those prop firms that really stand out to us.
We spoke before. It was multiple diversified systems, applying them systematically across multiple different time frames. Where are you in your total number of systems these days?
Yeah, you can talk about the systems individually, and there's several thousand in the portfolio. Or you can talk about the ideas, which are broader conceptual frameworks that we work with. So, for instance, in my area of the portfolio that I oversee the strategies in particular, I'd say there's probably 25 conceptual frameworks that I'm working with there. And I think the rest of the portfolio managers in the firm think in the same way. So they have a broad conceptual framework, and then they apply it in particular with a strategy, and may even vary it slightly in the different markets because markets are different. The universals apply throughout all markets, but there are particular aspects of each market that you should probably take into account. So what I like to say is that the markets are the same in principle, but at the same time they're different. So we're dealing with two sort of different formulations of what markets are. Do you optimize for each market? Well, not heavily, but yeah, there are variations for each market. And that may count as an individual strategy, you see. So that's probably why the number is as high as it is.
You would like your models working across all markets, though. I mean, if that model works, you want it working at all markets.
And when you're doing the testing, you want to see it apply universally, I think, across all markets without much variation. Actually, without any variation. So that's step one. After that, you may go in there and take a closer look at it. Because one example clearly is that there's a lunch hour in Asia in Hang Seng. I think it's Hang Seng. Yeah, Hang Seng takes off for like an hour and they go to lunch. If you're going to trade that, you have to account for it. It's almost like a new opening, the second round. When they come back from lunch, it's starting fresh. Back in the day when I wrote Opening Range Breakout, I don't know if I took that into account. It may be something to take into account. Have 2 openings a day in the Hang Seng market. Well, that's a unique sort of construct. You have to take those kind of things into consideration. But the general principles apply. That's certainly what I've seen and tried to adhere to, is that because that's a more robust framework than when you're building these portfolios. There's not any clear-cut statistics that tell you what it is you're supposed to be doing with a strategy. There's just not that much insight in the stats. But what you do know is that if you can find something, a widget that can be applied in sort of a universal, general way, then you have something that's really, really powerful.
The phraseology you'd used years ago with me was a kind of an assembly line thinking is what you were, that automation and being able to apply it religiously.
Yeah, that's it's an appealing way of looking at it. Sometimes it really. I think what it does is it keeps you honest when you're applying these strategies. So that's very important.
So Toby, when you're talking with clients, or you get the random elevator pitch, but you probably don't get too many of those, or you have to give the random elevator pitch, people want to know, where did the profits come from for Covel Capital Management? So, you've got counter trend strategies, you have momentum style strategies, you probably have others that I don't know about, but where philosophically do you see those profits coming from? Why are you able to extricate those profits from these liquid markets, liquid futures markets, et cetera?
Well, I think when we're successful, what we're trying to do is find areas where it's very difficult for participants to act, places where there's market price action that aren't comfortable places for a human being to trade in the way that we're trading. And those seem to be the most profitable. And if you're a discretionary trader and you're doing that, either you're rewiring your sort of innate psychological disposition in order to do that sort of thing, or the fast track to this is to quantify it and then just let the machine do the work. But over time, a discretionary trader going against his nature, fear, greed, it will wear down because it's traumatic in a way. And that's where the automation is a real help. You need in order to get an edge, you need to do something that essentially nobody else can feel comfortable doing. I mean, there's got to be some people, but you may be the first, or you're very early on. So the recognition of that requires a little getting ahead of it a little bit. Seeing the market work itself into a position where it's vulnerable to sort of weak thinking that can take place because we are vulnerable as humans. That may be too philosophical, but the problem, you don't want crowded trades. You want to be there when it's very difficult for other traders to operate. And that's sort of the wonder of systematic trading, I think. It's a real benefit. But that said, we tend to try to find the times when it's right to go against price action. And then, as my early work would suggest, I also was looking for times when the market is ready to move directionally in any given, day, and isolate those environments. That's an interesting area of work. The markets are different at different points, and that has to be taken into account. You have to. It's almost as if there's two separate, but there's more than that. There's many different environments, but traditionally our portfolios have been separated into at least two primary areas of mean reversion and momentum. It's our job to find out when it's right to do that.
You've not strayed from price action. I mean, your firm is price action at its foundation.
Yeah, and everything else that kind of goes along with that. I mean, volatility and volume, and there's other factors I think that are primary in that. But price action is a starting point. Price is a starting point. It makes it easy too. I mean, you get a lot from just looking at price alone. There's a lot there.
Talk about volatility since you bring it up, and I think everybody knows in the last month or two, we've seen some significant volatility across the board. And volatility is something, and a little bit of chaos, a little bit of markets starting to have that enthusiasm. That's not something, that's not a negative for your firm.
Well, it depends. There's winning and losing volatility. We prefer the winning volatility. At this point, what we have seen is this, and then it's changed a lot of things in our firm. That up till a few months ago, the volatility was at record lows in most of the markets. Foreign exchange market, the interest rate markets, even the stock market as it was rallying was on relatively narrow trade day to day. And so the volatility, the VIX was at a very, very low level until just recently. But with the foreign exchange markets perking up in the last couple of months, literally in most of the foreign exchange markets, euro currency, dollar yen, you had the lowest volatility range that I've seen since I've started trading, and those were relatively good markets for us to trade in the past. If the volatility gets too low, there's no movement. There's nothing to really take advantage of. You need price movement. What's happened though is all of the markets, starting with foreign exchange a couple months ago, have changed, and the volatility has increased at least doubled, which is a welcome to what we need and for profitability. We need price movement. Now the other thing, of course, we need is volume. And of concern is what happened in the last week or so with a lot of the markets when you had these very large price moves. The volume dried up significantly. And we haven't really seen that. That's a new phenomenon. It's sort of this early in a cycle of volatility. This is sort of a unique circumstance, which leaves a question mark for me as we go forward in the thinking that we're doing about allocations and the kind of risk that we may have in the market. So that's another story. But the volatility has increased. It took a long time. I don't think this is going away. As markets contract like they did for as long a period as they did, it's my opinion that the volatility cycle is on the rise rather than declining in most markets. So something's up, in my opinion. Economically, I don't know what that is. I do suspect that with the amount of intervention that's taken place in the markets over the years by some of the governments, that the U.S. in particular, it's created a circumstance that can end up being very volatile, in my opinion.
Let me interject real quick there, because I think this is something central to your firm, and we talked about this when we first spoke, is the idea of shocks. And, when these volatile situations start, we can think back to the summer of 2007. It was almost foreshadowed what came into 2008. Now, of course, I'm not trying to make a prediction or anything. I'm just talking. But the idea of shocks, rubber band snaps, this is something you think about all the time. You're prepared for it. And you knew as a young man, and you saw this happen to other people, you did not want your risk. You didn't want to risk your career on price shocks.
Yeah, that's the truth. Well, we still have occasional bumps in the portfolio that certainly cause some sleepless nights. I mean, not. But look, I mean, the clients have a certain appetite for drawdowns, and if you're within the range that you propose, and if you can adhere to that, you're in good shape. You're doing what you say you're going to do, and that's very, very important when you're endearing trust in a program like ours. So, but yeah, price. I think we could say just in this last week we've had something of a price shock. When you see, every time you see those, you understand where your weaknesses are thoroughly. So that's an area of it. It's a learning. If you can continue trading through that and you're okay, you haven't had a huge drawdown or hurt your clients very badly. You've learned something, and there are things that you can put into place that will protect you further from these kind of things and these kind of events. And then, of course, you try to think ahead at what can create real problems for the portfolio. But it takes a really thorough knowledge of what's in there and how the portfolios evolve. And there's a lot of production going on in our company, a lot of strategy development, and you have to stay on top of that and really understand what it is that people are implementing in the portfolio, and so to truly understand your risk. But that is it. Look, if I'm building a 50-year track record, and I'm almost halfway there on this, which is a goal of mine, you have to be able to get through those price shocks. Those are the things that are lurking out there that can thoroughly put you out of business. And you're right. I have seen it before. It could be terrifying.
You started your career as a guy with higher drawdowns, much higher drawdowns.
Mm-hmm.
So you've changed that. I mean, like a complete opposite side of the coin. I mean, you've gone from high drawdown to, I think I was looking today, between a max of, let's say, 15 to 16% on your big portfolio.
Yeah, and it's been a long time since we've seen that. That's a pretty big drawdown. I think we're right. That would be a big drawdown now. So, hopefully our risk-adjusted return is improving. But when I was trading at the beginning, I wasn't thinking about portfolio management, and I wasn't really tuned into what a client would want from a portfolio. So risk-adjusted return has become the primary benchmark measurement for our firm. So certainly we do want to have a consistent return, but a decent return, but we also want to do it in a way that, in a less chaotic way than, say, the S&P, and its long only position in the S&P. We would think that we would be far, far better than that. Our drawdown should be less and our return should be higher, relatively speaking, than a lot of or any instruments out there. So we really want to be at the top of the risk-adjusted group in the hedge fund world.
I think you told me years ago it was, and you might be less today, but 0.02% risk per trade.
Yeah, I think it is less actually, because of the more strategies you have, the less you allocate to each one. But that's part of the risk reduction in itself. There's diversification and low correlation between strategies, and the more you can bring on that are truly not correlated, it seems like the better.
I'd love to pick your brain just for a second and pretend this is like an audience question. So the trader out there, the would-be investor, and they love their one market. Perhaps they only fixate on one market, perhaps a currency or perhaps just one equity index. And then when they start to trade, they put these huge amounts of risk on. Maybe they could get 5, 10, 15%, perhaps more into this one market of their net worth. Why don't you talk about, I mean, you've been testing systems and looking at these things for decades. Just give the big picture out of the gate, why that's such a bad thing to do, to be fixated on the one market and to be extending yourself risk-wise. I mean, everyone should know instinctively if you start risking that amount, you can blow yourself out. A couple losing trades and you're gone. I mean, capital's not unlimited.
Well, there's the allure of the profit too on the other side of that. So it can be quite appealing. Visions of change of life and quality of life if you can hit it on that trade. That's a problem. There's a gambling element, gambling mentality that's leading that. But I think this is part of the evolution of any trader. When I started out, I traded. You trade one market with one strategy, if that. You have a partial strategy undeveloped. So, but as I moved along, what I've done is I've broadened out that and tried to diversify through different markets and strategies, and we're still doing it. And I think we're trading 300 markets now, which is much more than I think when we last talked. That's 300 futures markets and foreign exchange. So, equities presents a whole area of diversification if you do it right for us. For the beginning trader, though, I mean, if you can imagine a discretionary new trader, he doesn't have the knowledge base. He doesn't understand a lot of different strategies. He starts with one strategy. And I heard a quote from Richard Dennis. I think it was in one of the Market Wizards books, that at the beginning of your career, you should be trading the smallest or the least amount of capital on the line, because that's when your knowledge level is the lowest. And as you increase your knowledge base, you can increase your allocation. I think that pretty much says it all. So to a new trader, it should be a learning experiment at the outset. And if you're experimenting, you don't do it with a large amount of your capital. You do it with a very small amount, just maybe represented, or you don't do it with any capital. You just paper trade. But you evolve into a more complex trader if you can stay. Caveat on this is if you can stay in the game to learn. So you don't want to damage yourself. There's a lot of people who just drop by the wayside because they just cannot handle the loss if it's too big. Those traumatizing losses can take you out of the game. And if you're not in the game, you can't learn. So you want to stay in. You want to stay in the game. You do not want to risk so much that it just totally traumatizes you.
Was there a moment in your trading career where you felt like, wow, I'm at the point where I'm at the cliff and this could go drastically wrong? Or did you shift gears completely at some point in time and say, I'm just walking away from, we talked about having steeper drawdowns when you were younger. Is there any kind of moment that you could think back to, that kind of a revelation where you just said, wow, okay, I now know the direction. I see the space where I should be?
I think that when I went and worked Victor Niederhofer's shop, it was very, very clear to me. It was a sort of an integrating moment for me because I could see the research platform that was the best I'd ever seen, bar none, and it was a great team that was working there, and he had hired very, very well, and I was just happier than could be to be working there with someone like Victor. Now, Victor has different risk parameters on his trade. That's another story. But as far as a researcher and a market philosopher, I've never seen anything like Victor Niederhofer. He's an amazing man. And the fellows that work there, a lot of them I work with now. In fact, in my firm, we have 6 or 7 gentlemen that I met back in the early 90s when I worked there. But whatever the 10 or 12 years, when I started in 1980 around the floors of the exchange, when I got to Victor's 12 years later, I had a pool of market knowledge that I'd kind of developed the hard way, and when I brought it into Victor's, it just it sort of came together for me. I felt confident that I could make something happen in the field. It wasn't that I wasn't profitable previously in the 80s, but it wasn't as consistent as I would have liked.
Might be a good time to interject just as a kind of a side note. And I know this a little bit about Victor's background too, enjoying the philosophy of objectivism. And I believe you do as well. Would you mind commenting on how that has affected your business life, your life in general, your entrepreneurial life?
Well, in the 80s, I think when I started trading, I just got off the tennis circuit. I played in Europe for a few years, played team tennis there. And my philosophy, my view of life was a little bit different, and I didn't really objectivism. I came across what Atlas Shrugged in 1986 and read that, loved it. What it did for me was, and this is the marvelous thing about Rand's work, is it provides a very clear-cut moral code. In fact, the only one that I've really ever seen that supports what we do, capitalist behavior, the capitalist system. And so for an entrepreneur like myself, I really felt it was essential looking back on it, it was essential to have incorporated that in my life. It changed my thinking. It justified my actions. Markets are very, when you're around the exchanges, you kind of look at your fellow trader, say some of the guys that came off the floor. These are some rough and tumble fellows that were around the Chicago exchanges, and I almost, there were times when I wondered whether this was really what my calling should be. In fact, a couple of times in the 80s, I went and interviewed for jobs as a tennis pro, and thank God they didn't hire me because I may have been doing that. Of course, I would have found out quickly enough that probably wasn't what I wanted to do after all. When I ran across Ayn Rand's work, it was an integrating moment for me also, and it led me to Victor. Now, Victor has variations on his own position philosophically, and we all have our different views of things. Essentially, he was a free market thinker, and we met because of that. And plus, he was a racket guy, and he liked tennis players. So that I went out and played tennis with him quite a bit at the beginning. It was an entry, along with my book. It was an entry into Victor Niederhofer's world. But those are huge, I think, very, very important moments for me. I can't say enough about it. It's still an important. You really can't justify. I don't think it's very hard to. There's a lot of confusion, I think, philosophically, and look at the regulatory groups out there and the people clamoring the newest book on Flash Boys and the beatings that traders are taking at just about any level. And how do you combat that in any way without some sort of sound philosophical underpinning? And I think Rand's philosophy provides that. It's an excellent moral code, in my opinion. It's a sane moral code.
Let me add back just one little bit on Victor, and I think it's interesting that everyone can read the press accounts from the last 15 years and whatnot, and many of those ended up being negative. And of course, he runs a very popular site, and a lot of people contribute there. But I think what's interesting is how many notable traders cut their teeth there. I mean, his brother, for one, many others that you can name off. So it's really interesting how many people really gained a toehold and a foundation. You could argue that you guys in some ways were another version of Turtles, perhaps, just a completely different setup. But I mean, there's a lot of people that came from being around him to have great success.
Well, Richard Dennis, I think when he had his experiment on whether he could train traders out of, create traders out of nothing, he brought in the original Turtles, and I think that was fascinating. The one commonality is that they're quantitative. Victor was running a business. He needed to hire people, and what happened is that it was a quantitative shop primarily. You learn the ropes when you went in there. You were you work with the master. He was a powerful intellect when you worked with him. He was a professorial. He was tough. But he was a real teacher. Now, the turtles, I don't know. I don't know as much about that. But as far as the fanfare around them, I think some of those guys have done very, very well. They have a lot of volatility in their portfolios. But they are generally all quantitative, and that's the real similarity. And you can teach quantitative work. It's something that is transferable, I think. Developing a portfolio is a little tougher. I know Victor never really taught portfolio development. I think Richard Dennis may have more. They diversified through many, many markets right at the outset, and I think that was some of the portfolio work that I do started with his allocation concepts that I drew from the readings and some of the turtles that did talk about it. So there's basic allocation methods. It's a good starting point when you're allocating to a lot of different markets. But I'm lucky because I met a lot of these fellows. Monroe Trout was also came out of Niederhofer, which is probably of any of the graduates, he's the most successful. And we don't hear about him much anymore. He's theoretically retired, but he was brilliant and did a fantastic job of building a business.
Hold on. Theoretically retired.
I don't know. I can't tell.
We'll leave it at that.
So anyway, he's a great example. But we have, like I said, we have 4 or 5 portfolio managers in our firm that all came out of Victor's, and some of the best, I think, other than Monroe or Roy. So it's rewarding. It's a great group to work with. It's a wonderful sort of intellectual environment that we have that I'm very comfortable with. When I first started, I was a little lonely. I missed the guys at Victor's because there was a camaraderie and a very interesting. It was an interesting group of guys, and luckily I've been able to bring them on as time has gone by.
Hey, Toby, you mentioned 300 futures contracts today, and I think since we've been talking some of the quant style at the longer time frame, trend following models, and some of the shorter term models. For example, some of the guys that you mentioned that you got to know from Victor Niederhofer's shop. I think there's another commonality there, which is the liquid futures markets. So many of the traders that everyone reads about and all the books, the Market Wizards books, futures trading. There was a tangible liquid. I mean, why don't you talk about futures trading for a second?
Well, I think it's the most liquid markets that we can trade, and I think that there's central clearing, there's objectivity. I think things are extremely visible. We can liquidate our positions very quickly if we need to. That's comforting, I think, to the clients. I think a lot of the best traders started there, or they gravitated towards these are very, very liquid instruments, and their strategies were worked around very liquid trading instruments. And I think it's no mistake. I mean, I think you look at some of the most successful traders out there: Paul Jones, Louis Bacon, Monroe Trout.
The list goes on. Paul Jones, Bruce Kovner,
Jim Simons,
David Harding, everybody. Yeah,
they trade a lot of equities, but that's an evolution. I think they started with the futures markets in a lot of cases. So it's a great place to learn. it looks like there's opportunity there to a trader, I think, when they first enter the trading world.
You're a pretty ambitious guy, Toby. We talked about that years back. Give some inspiration to people out there. I think sometimes people think that there's this tried and true method. There's this system that you can follow for life. If you just work for this guy, everything will happen. But as you've talked about in this conversation, it's not that. There's no straight line. There's no do this and you will win. But I think a lot of it, if anyone's listening to you, it's persistence. It's just drive. It's find that passion, find that calling, and stick to it, and know you're going to take body punches. You're going to take gut shots, and it's how you pick yourself up.
Well, yeah, and try not to get hit too hard. Stay in the game so you can learn. The learning process. Look, we're all going to make mistakes. One of the most important things for me is that I was very clear. I needed to learn. I needed to feel that I could develop and get better. So my market IQ could expand and improve, and my understanding of the business could expand, and I could get better at it. It wasn't a static place for me. I think that, and that's what has happened. I learned. And I think that we all do that. We have to know that at the beginning we don't have as much. We may be very, 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 very bright people that come to the markets. I can't tell you how many PhDs in the sciences are being hired now by these firms to come in and do research. We do it ourselves. We really look for scientists and people that have great quantitative skills. But without market knowledge, there's they don't really have anything. So that has to be developed, and you have to be able. Mastery doesn't come in a year or two. It's a relatively long process. It seems like maybe a 10-year minimum anyway. If you're going to get to a point, by the way, I mentioned that I don't think I've mastered this quite yet. I still have more work to do.
Hold on, the 25-year track record says something. I'm not sure what, but it says something.
Yeah, it's not bad. But look, I think we're really just that idea of trying to improve. In order to do that, you have to be passionate about what you're doing. You really have to love your work. It is your passion. So without this sort of constant fascination with what the market is, for me in this area, I think it's true in any profession. You find what you love and be thorough about that, and then you master it over time. And I really don't. There are certain limitations that we have on the planet. It's wonderful what we can do as human beings. I mean, we can actually get smarter by building our pool of knowledge, make better decisions through practice. I mean, trading isn't much different than hitting a combination of underspin and topspin backhands. You have to hit thousands of them, and you get better and better at it. That's what we do, and I think that it's sort of the human condition. And finding your passion and then mastering it, I think, is one of the highest levels of what we do, what we humans do on the planet. So it's I hope that conveys.
No, it does. Listen, I appreciate you taking the time today. I could keep you all day and just keep chit-chatting about all kinds of stuff. I do have one kind of last we could keep talking, but I have one last thing I really kind of would love to touch on. And you've talked a little bit about who you admire and some of mentors, and we've talked a little bit about that. I'm curious, though, for people out there, trading, business, philosophy. Clearly, you have a very strong philosophical perspective. What books do you really admire? What have you loved to read over the decades?
Well, if it's about markets, I think you have to look at Jack Schwager's Market Wizard books. I think it gives you a great view of some really great traders. I think that's inspiring stuff. Reading about the really the highest levels of the profession. I think it's really, really important. It's the inspiration, that's the food you need to go forward. I have to say, Ayn Rand's work, I think, the introduction to the OPAR, I think they call it, or they have a general text on objectivist philosophy that Leonard Peikoff edited and wrote, and it's a wonderful book, and I think it gives a very clear exposition of sort of the laissez-faire approach and the philosophy of objectivism, which I think is so helpful to anybody out there. What other books? Of course, Atlas Shrugged I thought was wonderful.
I'll interject one here as we're along this line of thinking. I'm calling you from Saigon today. So Vietnamese girlfriend, I bought her the other day. She speaks and reads English, but I bought her the Vietnamese version of The Fountainhead, and she went through it faster than lightning. She seemed to really enjoy it.
We have a winner there.
Yeah.
That's great. That's a great book.
If you get through The Fountainhead fast and you love it, I agree, right? Yeah.
Yeah. I would also recommend Victor Hugo's work. It's some of the most beautifully written stuff and inspiring things that I've ever read. So, but at any rate, that's all part of our mastery, is reading as much as we possibly can. It's something it may be a lost art, these days, but with all the electronic stuff.
I'll still take a physical book over a Kindle any day of the week. I don't mind searching for something on the Kindle. That's great, but I'd rather have I can read faster with a physical book. Everyone can, I would think.
You must be over 40.
Yes. Hey, Toby, listen, it was great chatting. Hopefully we can talk again in the future sometime. I'd love to have you back on. We could, I think people are just going to enjoy this conversation.
Sure, we'll do 10-year checkups if you want.
Well, I'm gonna have to bring it lower than 10. We can't do that; it's too long.
I'll be here.
I know you love giving some good philosophical bents, though. So, hey, people can go to check out your firm at Crable.com, correct?
I believe that's right. Crable, something. Crable.
They'll figure it out. They'll figure
it
out.
Something.
Yeah, they'll figure it out.
It's not a solicitation.
No. I'm just informational purposes. So don't send any crazy things to Toby and all that kind of fun stuff. So
buy my next book.
Is one coming?
Yeah, I think I'm working on it. I've got a few years into it now, so it should. The formal book will be an appendix in the new book. So because and then it will be updated. But there's a whole storyline on that too. I think I will publish something down the road here. I'm working on it.
Cool. Awesome. Yeah. Hey, Toby, it was good chatting with you again. I appreciate you taking the time today.
Thanks, Mike.
Okay, take care. See ya. Coming up as part 3 in this mega episode is Ewan Kirk out of the UK. Some great insights. I really need to get him back on again. I liked the mechanical, systematic way of how he thinks. Today in the show, I have Ewan Kirk. He's the head of Cantab Capital in Cambridge, in the UK. Ewan brings very clear and strong opinions. I'm sure there's probably a few things that he says in this interview that will be enlightening, and perhaps a few people will feel like their feathers are ruffled. But nonetheless, I love it. What a great story from 2006 to today. Growing his assets under management from around 30 million to over 5 billion. Inspiration as well. Ewan has seen his net worth climb from not super high to super high. I think super high, a $500 million plus would be quite inspirational. A trend-following trader plus other strategies, but clearly a trend-following foundation. One thing to keep in mind also, September of 2014. For all of the last couple years where you'd read these articles, is trend following dead? Is trend following dead? Trend following's over. September 2014 comes along and boom. It's not about consistent profits. Consistent profits, predictable profits are the holy grail. You're never going to get there. Better to have a strategy that takes those small losses and then finds those big months, those big periods where the world changes, where profits come unexpectedly. That's trend following. I hope you enjoy this conversation. And if you'll indulge me for a moment, I would love to go back in time a little bit. And I'd love for you to paint the picture, because we're going to break apart your trading strategy, your management strategy. I want to break all that apart. But before that, a guy with a PhD in mathematical physics going to Goldman Sachs, you weren't the guy that was living and breathing trading when you got there, were you?
Not at all, no. When I turned up for my first interview at Goldman Sachs in 1992, I didn't actually know who Goldman Sachs were. I thought that they were a bank, but apart from that, I wasn't entirely sure. So no, I didn't live or breathe trading. I didn't even live or breathe quantitative finance. Probably couldn't have discounted the cash flow.
So they were looking for a certain type of thinker, a certain type of thinking.
Yes, they were looking for somebody who had some sort of mathematical background, and computer programming is also important. I say this to just about everybody that we interview, that it's sort of useless being a mathematician, being a statistician without being able to computer program, or without being able to program a computer rather, because it's like being a novelist who can't write. The way that you express your views or express your ideas is through programming computers. And so I was a reasonably good computer programmer. I had a background in quant, and Goldman very kindly took a punt on me.
I saw that your co-founder, Eric, he called programming, he said it's today's literacy. You have to have it.
It's today's literacy. And that strand runs through a lot of my career, but also runs through what we do at Cantab. Everybody programs. I myself have just spent the last 2 or 3 weeks programming up a piece of our infrastructure. There's no rest for the wicked, as they say.
But as I lay that foundation, as you talk about your background, it's going to look to the audience out there that there's this perfect physics, mathematical background. But you're also a guy that you go to work at Goldman Sachs, and I've seen this mentioned in the press. You allowed yourself to turn up at a black tie dinner wearing a kilt.
Yeah, that's true.
But I'm curious, though. You're not a cavalier guy. Obviously, you're very grounded. You're very, you think in terms of risk. So, but what was your thinking there? What is your thought process that you allow yourself to stand out like that?
Truth is, of course, that for somebody who, like myself, originally came from Scotland, the traditional black tie dress is a kilt and all of the attendant bits and pieces with that. So it's not like I turned up in a clown costume.
I hope you did not infer that that's what I was saying.
No. I'm smiling as I'm saying this.
Okay.
But I do think that one thing that Goldman Sachs was very good at doing, and presumably still is it's tolerant to some degree of idiosyncrasy. Certainly in the early days, Goldman was a partnership with maybe 150 partners running their small businesses. That made it very much a meritocracy, very much a what have you done for me today kind of thing. Me turning up in a kilt is not the strangest thing that I've seen, but it's a place where really much more so than other banks, certainly in the 90s, it was a place where all Goldman was interested in were you good at your job? Within certain limits, obviously, turning up at in a clown costume at a client meeting would probably be a very quick way of getting fired.
I took it as a complete outsider reading about it in a press account. I just took it as you saying, look, I'm going to march to some music that is standard, but I'm going to think outside the box. I'm not going to just be the guy that's clocking in. That's as an outsider reading it, that's how one takes it.
I probably couldn't violently disagree with that view, no. I think yes. There's certainly some of that in me, is to not just be the guy. Although to put this in context, Goldman Sachs, to take that as an example, Goldman Sachs is a very serious, very successful U.S. corporate, and there's a limit to how outside the box you can think in a bank, and quite rightly too. Banks are responsible for a lot of risk for their customers. They're responsible. They have a fiduciary duty in lots of cases. Yes, you can be a little bit idiosyncratic sometimes, but at the end of the day, it is a big U.S. corporate.
I want to break apart some of your strategy ideas and how your firm operates, but I wonder if you would be willing to paint a picture for me. I'm curious, when I can look at the success of the London CTAs, the London quants, those many that have trend following backgrounds, why did the switch happen? Why did London become the spot? For example, so many of the long-standing early pioneer trend following CTAs were from the US. What was the switch flip?
That's a good question. It's not one I immediately have an answer for, but I can speculate. I think if we think about the very early trend following, the history of the industry is the very early trend following, the turtles. We're talking mid 80s there, maybe early 90s. The kickoff for the London, or maybe better to call it the European scene, probably happened in the mid to late 90s with AHL, obviously, the granddaddy of us all, and then Winton and Blue Trend and Aspect and ourselves and a whole plethora of really great firms in Europe. I think partly the reason why we maybe managed to become more successful or grow was more of a scientific approach to investment and statistics. I look back at some of these things that I see in the old tattered books about average true range and breakouts, and it seems like the dark ages. We are thinking in a much more statistical sense, much more scientific, I think. And it's not just enough that it happens to have worked. Possibly that's, maybe we can thank David Harding and the rest of the team at AHL for building that into the consciousness, and then it just takes off. Why? So the question there is, so why didn't the CTAs in the US follow that lead? I would clearly believe that a more scientific approach to investing, a rigorous statistical approach to it, I clearly believe that that's better than just a rule that happens to have worked in the past. But it's not clear to me why that would then not be transplanted back. I remember, even though we started in 2006, 2007, I do remember people asking me, again, particularly in the States, why do you weight your positions by risk? Why don't you just take a constant lot quantity? 1 lot of this, or 10 lots of this, and 10 lots of that, and 10 lots of the next thing. And obviously that's, there's no other way. That's just madness in a world where you have a contract like the wheat contract, which is maybe, $20,000, and the nickel contract, which is $250,000. I mean, it's just an insane way of doing it. But it was the tradition, and our industry is quite conservative. The idea there's a small subset of investors who want the new thing, believe maybe that there's some fabulous technique out there that's just going to predict what the S&P is going to be tomorrow. But there are also people who want it to be the way it was, and anything that steps outside that is maybe a little bit different.
Fair enough. Let me jump into some issues that are near and dear to you, central to how you look at markets, your trading strategies. You're talking to clients and you have to tell the new client, and this could be a very experienced client, perhaps they're not experienced with your strategy yet. And you ultimately have to bring up the conversation of, hey, look, losses are statistically inevitable. You can't get around that fact. Now, there's still a significant number of people in the population out there, whether they're very astute about investing or not so astute, they still don't want to imagine losses as part of the game.
Yep. People are desperate to invest in something which never loses money. And that is, of course, why Bernard Madoff existed. There's a great phrase by John Maynard Keynes where he said, in the field of fraud and deception, demand creates its own supply. Everyone is desperate. Everyone is desperate to invest in something that doesn't lose money. I'd like to invest in things that don't lose money. I'd like to come up with a strategy that never loses money. I mean, of course, we all want that. But the reality of almost all investing is that, if you're really good and or really lucky and you've got a very long track record, maybe 20, 30 years, and you've never changed your strategy over that period, which of course none of these things are really true for anybody, maybe the best you can hope for is a Sharpe ratio of 0.8, 0.9, maybe 1. I know that there are some more liquid, say, stat arb strategies which can outperform that for a long period of time, and then, of course, August 2007 happens. But broadly, a good investment strategy, an outstanding investment strategy, is something which, over a long period of time, has a Sharpe ratio of 1. Investors should really want that. So, a 20% volatility with an average gross 20% return, that would be great. But that does mean something with, say, a 20% volatility. Every 2 years, it's going to have a drawdown of 15%, statistically. Every 4 years, it's going to have a drawdown of 20%. This is just what happens. Even if the system truly has that return profile, it's going to experience those kind of drawdowns, and it's going to experience losses. I have a little spreadsheet that I sometimes show to clients when I'm discussing this, which, and broadly we don't really use spreadsheets, but it's a nice little tool, which sort of simulates 5 years of returns, daily returns, from something which is a 20% return, 20% volatility process. So, effectively a Monte Carlo simulation, if you want to call it that. And every time you press F9 on this spreadsheet, it draws another graph of another realization of this random but positive process. You don't have to press F9 very often before you get a history which loses money in a straight line for 5 years, which has a 40% drawdown. And remember, this is something which is guaranteed to make 20% per annum over a long enough period. So the expectation of losses is something that everyone should build into their investment process at all times, and it's something that investors do. And the majority of our investors are institutions. They're pension funds, they're insurance companies, they're sovereign wealth funds, they're endowments. To be very fair to these investors, they are really quite sophisticated and they understand that. And so I think, sometimes when you're speaking to maybe high net worth individuals or smaller family offices, the desire there to protect capital is much stronger. You have to be extremely clear about the fact that there are things that will happen in the future which will be unpleasant. The other thing you have to do is explain to investors when you're making money that it probably won't last.
Do you see the demand for that discretionary macro trader hedge fund that just says, trust me, I have the experience, I can call the direction, I can position these multiple futures contracts across all these different markets, just trust my discretion? Do you see the demand for that waning?
Obviously, by the time somebody's sitting on the other side of a table from me, they're probably not going to be asking me that question. And I am, of course, very clear about the fact, particularly when people say, well, do you take risk off? Do you put it on? How about taking off your bond position or adding more of this? I'm very clear about the fact that I cannot see into the future. I'm not psychic, so therefore I don't have any skill in that. That my skills lie elsewhere. There is an argument that, at least in terms of positioning longer term, maybe nobody has skills like that. Maybe it is just impossible. I could certainly argue both sides of that. I think the demand for discretionary trading probably comes from the reactive demand. It's extremely hard to write a model. Well, it's impossible to write a model that can react to every last move in the market or react to a piece of information that's coming in. I don't know, September the 11th is probably a very good example of a piece of information that arrived, the world changed at 9:02, and systematic models knew nothing about it, whereas discretionary traders clearly did. So in those kind of events, it's quite possible that discretionary traders will outperform, and I can understand why people have that demand for it. But it is an extremely difficult job to be a good macro trader, and we all know of those people who have great reputations in doing that, and it's maybe only a handful of people. Of course, the interesting thing about macro trading is that everyone wants to be a macro trader. It's really interesting when you hear stock pickers talk, discretionary equity long short people talk. Very often what they're talking about is macro things. We think the market's going up, we think it's going down, we're doing this, and then therefore we're going to buy these stocks. And quite often macro decisions are wrapped up in security analysis, which they probably shouldn't be. I really think trading macro on a discretionary basis is one of the world's hardest jobs, and it's possible that the people who are successful at it may just be the lucky pennies. I don't know. I don't have hugely strong views on this, but I think it is a very hard job.
So the macro discretionary guys, when they hear, and I'm just kind of painting an illustration, it could be the investors that are hearing from you for the first time, but the macro discretionary guys, when they hear that everything you do is systematic, from strategy selection, asset allocation, portfolio construction, position sizing, execution, and risk control, that everything you do at your firm is systematic, that's got to cause some people to just go, what the blank? How there's got to be that aha moment of like, hold on, this is an approach that's different.
I don't think we are exceptional. I think it's, obviously, whilst I know the people who run my peers well socially, I don't know what they do and how they sell themselves, but I would be surprised if any of the large European CTAs are talking about how they intervene in what they do and they make some decisions. Remember, one way to think about this problem is that, and there is that little bit from people where, well, we have a model, but we occasionally intervene. My view of that is is not systematic trading. Systematic trading, I've used this phrase before, it's a little bit like being pregnant. You either are or you aren't. You can't just be a little bit systematic. I often say to people who, are maybe pitching me with systems that are a model that they then put a discretionary overlay on, I say, well, why don't you just run 2 books? Run the model in one book and run your discretionary overlay as another book, and then just see which one makes money. Once you think about it that way, the decisions, often this is a way for people to hide really quite complex decisions. Remember the point, that what we're all trying to do is we're trying to say what's more likely to go up tomorrow and what's more likely to go down tomorrow. And that's the decision. Now, what we have, and many other people like us, is we have lots of complex, or sometimes simple, models which have been tested statistically over many, many years, and then they're weighted using very sophisticated weighting algorithms and cost control measures and all of those other things, literally millions of lines of code running. And all we're trying to do is forecast whether or not something's going to go up or down tomorrow. Very often people intervene in their models by saying things like, well, I think vol's going to come off tomorrow, or correlation's going to go up, or I don't think this model's going to work as well tomorrow. Now, that's a very complex statement. The amount of analysis you would have to do to say that, for example, a trend following model isn't working very well and is unlikely to work tomorrow, since it's so difficult to do that for something as simple as an asset, the idea that you can do it for something as complex as a model which is running on 120 different assets with various risk weighting and cost control measures on top of it, seems to me to be unlikely.
Yeah, fair point. Fair point. Why don't you talk about part of your process under the hood, in the sense that you like the idea of prove a strategy is broken rather than it's right.
Yeah, I don't think I'm the first person to come up with that, in that, effectively that is the scientific method, which has been working pretty well for humans since the Greeks came up with it. Science is about proving things wrong. Okay, it's not about proving things right. What you're trying to do is break your strategy. You can never really prove that a strategy works or doesn't work. Finance, despite pundits and newspapers and people on the television, and maybe even people on podcasts, filling what they say with certainty. This is going to happen. This is the best way of doing things. Our systems are better than somebody else's systems. Our stock portfolio is better than somebody else. I know this, I know that. Finance is full of all of that. But in fact, finance is dominated by randomness. Randomness is everything. And so, because randomness is everything, you need to be uncertain. You need to have a lack of conviction and dogma in certain things, because you want to be able to prove that things are wrong. And so, when we come up with a new strategy or a new idea or a new trading system, what we're trying to do is, at least in, when we're simulating it and running it through all of our systems, what we're trying to do is find out what's wrong with it. And then if you get what is literally months of testing and retesting and rethinking about it and thinking about things in different environments and so on, if it gets through months of that, then maybe it's going to work in the future. And these are all very weak, uncertain statements. But to a great extent, the philosophy of what we do is around that uncertainty and of conviction. There's certain things I've got conviction about. Obviously, I've got conviction about the importance of technology. I've got the conviction about the importance of risk weighting or coherent portfolio design. All of those things I've got a lot of conviction about. But I don't have a conviction about any particular technique. You just do what you think is best and what you think will be persistent.
Yes, I love the way of dealing with uncertainty, because it seems like until the last handful of years in the financial fund management arena, so many people desire certainty. And so it's refreshing. And of course, as you say, you're not the only one. It's refreshing to hear that I just don't know. I'm doing the best that I can, but I don't know. And I really don't think anyone else knows.
Yeah, there's a little phrase that I sometimes use, which is that systematic trading it's what we are trying to do as scientists in finance is a little bit like sort of dimly being able to forecast what the weather is going to be like tomorrow. And it's like meteorology in that sense. It's full of uncertainty, and technology helps, and the models aren't perfect, and they don't forecast better than even the biggest computers in the world don't forecast the weather very well 5 days forward. But meteorologists are trying hard to improve that, both on the technology side and better theories about atmospheric circulation. And they're maybe not too bad at forecasting the weather tomorrow in certain places. Probably not in the UK because it's so rainy, but you understand where we are. In the past, a lot of investment has really been people looking at the sky and saying, "Look at that cloud; it looks like a dog." I think our way, and people like us, our way of doing it, I think it's what we do. I think it probably captures the realism of the world. The other sort of way of thinking about this is when, very often, and rightly, when something happens, either when you make money or lose money, or when a model does something or whatever it might be, there's always the question that everyone asks, whether or not it's internally, people at Cantab or our investors or journalists, why did this happen? It's a great question. Why did this happen? And what we try and do is approach the problem from perspective of the reason why this happened was chance. Now prove that it wasn't chance. Very often, that's quite hard. You have you have a bad month or you have a great month. People say, well, what happened? Say, well, can I prove that it's any different from chance? Quite often the answer to that question is no. But it's just a different mindset. And obviously you have to approach problems in lots of different ways. But approaching a problem from the mindset of, I think this might just be a result of random noise, let's see if we can prove that it isn't, it's intellectually satisfying, if nothing else. I think it's quite a powerful technique.
Let me ask something, I don't know, I really call it controversial, but I saw this great article that was about you featured in the New York Times. And I kind of went through some of the comments, and I noticed some of the comments were highly negative, and the thrust of the comments were essentially that you don't bring value to the economy. And I thought to myself, because I know something about what you do and what your peers do, and I thought to myself, those comments misunderstand, because there's so many of your investors, even if they're institutional investors, are representing the small guy. I mean, it's the small guy's retirement money that often makes it into the big institutional account. And so I think it's unusual that maybe people don't see that, yes, you might not be accepting Ma and Pa's retail account. That's not your position. But I think someone misses the point and misses the boat when they make that criticism. What's your feeling on that?
This is a hard question to answer. So the question is, are we doing something that is socially useful? Are we doing a good thing for the economy? That's a hard question to answer. Once you start going down that route, what is useful to the economy, or useful to society? The world only needs one car manufacturer. It doesn't need hundreds of car manufacturers. It doesn't need hundreds of models. So every car manufacturer is kind of not doing something useful for the economy. Nobody really needs an expensive meal at an expensive restaurant. So expensive meals and expensive restaurants aren't really doing anything useful to the economy. Nobody needs podcasts. We can live without them. There's once you get into that, then I think you're getting into sort of dangerous water. We are, I believe, over time, are providing something which is valuable to our investors. I think we are doing that as well as we can. We are constantly trying to add little incremental improvements that make the returns better. We won't make money every month, and we won't make money every year, and sometimes we'll lose money and sometimes we'll make money. But we are doing the best we can to produce positive returns for our investors. And our investors are, as you say, a wide variety of people. They're pension funds. It's as you say, mom and dad, as we say here in the UK, who are investing in this. And where I feel, although this is not quite the same as finding a cure for cancer, and it's certainly not the same as landing a probe on a comet, to use something recently, which are all fantastic things to do. This is what we do, and we probably, at the margin, make the returns of our investors' portfolios better in some way, either higher or lower risk or less correlated and so on. Where I think there's much more problem in people doing something which is not socially useful is when relatively simple strategies are dressed up as something very complex. People effectively just being an index tracker, doing long-only things, but just actually tracking the S&P index, but charging 2.20 for it. That's a very bad thing to do, I think. At least I believe that what we do is something that is intellectually rigorous. It's probably a good thing. The other thing to remember, of course, is that trend following, systematic trading, the money comes from somewhere. If we make money for our investors, somebody loses it.
And if you lose it, someone's gaining it.
Someone's gaining it. We would believe and hope that over time, we will make money more often than we lose, and that will, over time, give positive returns. But it doesn't mean that somebody is losing. And it's a very hard question to answer.
There's a game out there that everybody can play. Everyone can pony up to the table, and they can develop a strategy, and it is the ultimate game where everyone can try. And I'm not just being a homer trying to defend you from the comment, but I kind of look at it like, okay, you know what? And I'm not asking you to say this, but I can draw my conclusions about those types of critics. And it's like, hey, if you don't like it, go try. Ultimately, the libertarian in me is like, hey, I think we've got a lot of better things to do on this planet than draw those types of conclusions. And perhaps that if you look closely, you can see those positive things. But of course, we all know that some people will never see some positive things. So you can't convince everybody, right?
That's probably true. I'm obviously always wary about talking about politics in any public forum because it's not my job to do that. But, I do believe that we do a relatively good thing. We provide, if nothing else, I provide employment for 50 people in Cambridge, which is the small business side of what we do as well. And it's important to remember that, this little community that we have is an employer, and it pays people money and does all of those things as well. So I think, whether or not there's some great good out there that we all have to aim for, I do believe that we run good small businesses, and that is a good thing. So I'm very pleased about the fact, and one of the things I'm very pleased about is that in 2006, Eric and I sat in a small office with 2 computers and a server that gave us electric shocks every time we touched it. And from that, we have built a business. It's a small business, and it's a business that, like any small business, can go through bad times and could potentially go bust. And all of the efforts associated with running small or medium-sized enterprises, we've managed to survive for 8 or 9 years now. And I'm really pleased about that. If I'm proud of anything, I'm proud of that.
Well, it's inspirational. It's inspirational. I would love you to expand on the idea, and I think I saw you say that you, unlike maybe peers or other firms out there, you like to ask clients what they like. Not necessarily force things on clients. If you could expand on that, because clearly some clients are not going to have the technical market know-how that you do, so there's going to be some desire for guidance. So maybe I'm taking a little bit of that out of context, but could you expand on the idea of seeking client feedback for what they want?
That's maybe taken a little bit out of context. I think it is important to understand what your client's utility function is, to use that scientific phrase. What are they looking for? What do they expect from an investment? And that sort of informs the way that you explain things to them. As you say, generally, although all of our clients are very knowledgeable and sophisticated in lots of different areas, and of course they have to cover all types of investments and all types of asset allocation, they're almost certainly less knowledgeable than us in the very area that we do, systematic macro trading or systematic micro trading. So I'm struggling to remember that particular quote, but I think the point here is that you do have to understand your clients' drivers. What is it that they are looking for in their portfolio? What do they expect? And it isn't a question of us sort of sitting on one side of the table saying, what do you want? We've got it. You just ask, we'll give you that. But understanding what drives the decision-making process, who their stakeholders are. We, for example, we have 2 products. We have a original quantitative fund, which is higher volatility, it's 20%. It's higher octane, it's 2 and 20 fees, so it's very much in that mold of high octane, very diversified, systematic macro and micro trading. And we also have another product which is lower volatility. It's 10% volatility. It's much more scalable. It's got maybe just more basic trend and more basic value strategies in there, and it's available to investors at 1/2 and 10. Now, understanding your investor means that you can understand what their internal desires are. What do they need? If maybe they want a low-cost, very functional, but they want a low-cost system where it's lower volatility and therefore the headline numbers are smaller. We all know that investing in a 20% volatility product is too risky, then all you have to do is invest half your money in the 20% volatility product and keep half of it in your pocket, and you've got a 10% volatility investment. But somehow that doesn't feel the same as a 10% volatility investment for reasons that I really don't get. I mean, the pure mathematician in me says that's nuts. But nonetheless, it is true, and I, you know, I'm human too, obviously, and I feel that. So I think it is important to understand your investor, who their stakeholders are, and by understanding that and communicating with investors at the right level for an investor. None of our investors needs to know or cares about, you know, the deep statistical details which might be embedded in some nonlinear Bayesian regression portfolio algorithm. And that sounds great, but they kind of don't care, and they shouldn't care about that. But they should care about things like culture, technology, people, research processes. And these are all things that we can explain and want to explain in great detail. And if you can understand what your investor needs and wants, then maybe you can explain those things better. I always feel that I'm not really in that camp of, and our industry is quite bad at this, the industry of, well, you know, if I told you about my models, I'd have to shoot you. That's quite common, that sort of, you know, I have to be massively secret, can't tell you about it thing. I think that's wrong. You know, we as an industry are managing money for people, and it's their money, and they have the right to know, and we have the obligation to tell them what it is we're doing with it.
Yeah, fair point. And I think that probably has been one of the reasons that you guys have gone from zero to significant in fairly short order in a very competitive space.
Yes, we have. We were, you know, I'll refer you to my previous thing about randomness. You know, some of that is, of course, luck. You know, we had a good run. We didn't have such a good year last year. We're having a good year this year. These things, some of this is randomness. But actually, apart from being open and transparent and supportive of investors and all those things that you have to be, I think the other strand that runs through everything we do is that sort of aggregation of marginal improvements. Little small marginal improvements that really in of themselves maybe just don't make much of a difference. You know, let's say, I don't know, we work out some way of saving ourselves half a basis point in costs a day. That doesn't seem like very much. Half a basis point, that's a tiny amount of money. But it adds up to nearly 1.5% over the course of a year. That's great, right? We'll have that. And lots of those little marginal improvements are probably what distinguishes good funds from less good funds.
Ewan, where can we send people? People can go find more about you and your firm, Cantab Capital, online. That's easy enough. And if I'm not mistaken, I think I saw you somewhere on Twitter as well, yes?
I think that, I don't really tweet anything about finance at all. It's not, I don't think it's the format of 140 characters is not really ideal for extensive thought and analysis of things. But our website's a great place to find out a lot more about the firm. All of the contact details are there, and that really I actually quite like our website. I think it gives a very good impression of the firm and how we work and our culture and the products that we have. So yeah, the website's a really good place to find out about Cantab. And obviously if any of your listeners are in Cambridge, I'm more than happy to just drop in and see us.
Ewan, hey, my pleasure. Thanks for coming on today. I hope some of my questions were not too far out from left field, right field. I hope you seem to handle everything with aplomb and very smooth and diplomatically. So the one though about the guy that was the critic, he actually annoyed me more than anything because I was like, I just want to strangle him. But
one of the things you have to remember in life is that not everybody's going to think that you're great.
Yeah.
And there are valid criticisms. I'm quite phlegmatic about these things. There's valid criticisms about systematic trading. There's valid criticisms about the finance industry. And just getting annoyed about it doesn't help. You've got to take those criticisms on board, understand why they've happened. There's been a lot of, as we know, and lots of stuff in the press about bad things that have happened in finance.
Sure.
People are right to criticize. I'm not going to get annoyed about it because maybe some of the criticisms are valid. We certainly don't have a monopoly on the truth.
No, but as somebody who's watched this particular space for a long time and going back many, many decades, I think there is something noble about the systematic guys that have done this for a long time. I think there's something, as you talk about the bad things in the finance space, the Madoffs of the world, or a particular strategy that blew up that wasn't so great, there is something generally consistent that you can kind of hang on to in this systematic space. Like you said, though, maybe things break and it all falls apart at some point in time, but knock on wood, for several decades or more, it's done pretty well.
I think you can probably summarize it as, I think people in the systematic space, we try harder. To use that old Avis ad, we do try. I know just about everyone in the European space. I know that everyone is completely focused on just doing the best thing they can, and I think that's great. There's few. Well, I've certainly never met any sort of charlatans or people that are just knocking together any old rubbish just so that they can raise some assets. People try really hard, and sometimes we fail, but on average, I think the industry succeeds. And the industry's been in the doldrums for 2 or 3 years. There's been trend following in particular hasn't performed very well for probably the last 3 years. It's performing very well in the last 3 months.
That's how it goes, though, right? It's it's not necessarily consistency. It can just come boom, and you all of a sudden have a September of 2014, and everyone goes, "Where'd that come from?" And you're like, "Hold on, that's trend following."
That's the way it works. That's an interesting thing for people. I explain. When people say trend following hasn't worked for 3 years, if you take a simple trend following model and just run it across 100 assets, when trend following is working really well, it's maybe working on 60 assets and not working on 40. And when it's not working, it's working on 45 assets and not working on 55 assets. So there's never really been a period in history where trend following hasn't worked on something. It just hasn't worked on enough. And now, of course, we're in a situation where, and I've got to be careful always to say, we're not a trend follower alone. We do lots of other stuff. But trends in bonds, trends in ags, trends in the yen, trends in energy. This is all working out really well, and we're in one of those golden periods where trends are working on quite a lot of different things. That too won't last. Over time, there'll be ups and downs. But over a long enough period of time, trend following and more generally systematic macro trading has done incredibly well. And presumably, and this is the little scientist and uncertainty in me coming out, and presumably with a reasonable degree of probability, it will continue to work in the future.
Hey, look, if anyone out there looks at a systematic quant track record and it's all black ink, then you've got trouble.
I refer you to my previous answer about Bernard Madoff.
Yeah. Hey, Ewan, it was a pleasure having you on today. Thank you for providing some great insights and experience to my audience.
It was my pleasure, Michael. Thank you very much.
And finally, last but not least, a pioneer in financial futures, Leo Melamed. And I think Leo actually has a new book coming that I heard through channels with a publisher friend of mine. So I will try to get him on again in the not too distant future. Today on the show, I have Leo Melamed. He is a pioneer of financial futures, currencies, stock indexes. Leo was there at the Merc, making it all happen, along with many other people, but he was a leader. He is currently Chairman Emeritus of CME Group, formerly the Chicago Mercantile Exchange. What a great conversation. I'm lucky to get the guys that lived it on this show. I hope you enjoy. Let me jump right in, Leo. I was thinking, you don't recall for sure, because I was just a guy in the audience, but I'm fairly certain it was at an MFA event in Berlin in the spring of 1996. And I was at a small group meeting that you were presenting at. And I have to tell you, it was so inspirational. And this is before I had read your book, Escape to the Futures, but it was so inspirational just to listen to someone talk about overcoming odds. As a young guy who was starting out, it was like to listen to your story. It was just so inspirational to go out and make it. I mean, looking back, even for you, it's still got to be kind of crazy to look at your life story, isn't it?
Well, I do remember, this is in Berlin?
I'm pretty sure it was Berlin.
Yes, it was.
Yeah.
And you got the date right. And I did make, I don't know what remarks I made, but it was probably something that I usually do in terms of the futures market audiences. So thank you for your review of it.
Hey, listen, here's where I want to jump in, though. So I know it's something near and dear to you, and I've seen you give several speeches. I haven't seen them personally, but I've seen you give several speeches in the last few years and talking about China. And I thought before we did some, going back and discussing some of the key elements in your career, I thought your perspective on China today and where China stands with the development of futures markets, the benefits, and even give a little retrospective that I'm fairly certain the first Chinese president to come to America came to the CME to meet you and the leadership there before they went anywhere else back in 1985. Why don't you discuss this whole love affair that you've had with China, where you see things today as well?
Okay, well, it's a tall order, but I will try. Of course, I began looking at China directly after Nixon and Kissinger changed the view that America's view at that time was very highly negative, and they viewed them as a communist nation, which they were. However, communism, I kind of knew, was not one item. I mean, was not the same in everywhere it was instituted. And the feeling by the previous administrations was that it's sort of an amorphous thing, and once you're a communist forever, and it's always the same. I didn't think so. And when Kissinger and Nixon opened it up, I was very interested to see whether I was right or whether this was the same Russian-type communism, because if it was, that was hopeless, I thought, and there was no point in my following it. I had a visit. I arranged a visit from the Central Bank of China. I mean, this is at the beginning, so it was like it had to be around 83, or even 82. I went through normal channels to invite the central banker of China for a visit to the Merc, and lo and behold, they came. I guess it was in style after all. Kissinger and Nixon had been there, and they just wanted to show their interest or something. But they sent a delegation of about 3 people. I took them on the floor, and I gave them all my time I could. They didn't need an interpreter, and that was very helpful. They obviously enjoyed the visit. At the time, of course, we were still floor traders. This was all open outcry, and that's in itself kind of an exciting thing. They had never seen that. They asked me if it would be all right with me if they invite me to China, which I did, and I said yes, and I came. I think it was in 84 that I was there with a couple of people from the market that I took along. And they had the red carpet treatment of us. I mean, it was truly, truly all out to make us feel comfortable. And when I talked, and they gave me an opportunity to talk to some dealers and people in the marketplace. And when I talked to them, I felt these guys don't sound like communists to me. I mean, there's something to it, but these people are thinking of building some free market enterprise here or there and so forth. That's the background by which I invited the Li Shenyan, the president of China, who came in 1985. And since that time, I have spent at least one visit a year In the last few years, it's been more about 3 visits a year, which is hard for me, but fortunately, I'm only 39 years old, so it's no problem at all.
We're all only 39, Leo. That's the best way to keep it. I'm not 39 either anymore, but I like to think that I am.
That's right. What's his name? There was a comedian, an American comedian, that always said he was 39 no matter what. Anyway, so my last forays, which have been extensive, were to visit with all the futures markets they had. Now, they had a very bad history in futures. Many of those future markets they had, and there was a multitude of them, were bucket shops. They were nothing but gambling dens and really didn't represent the real futures market. No real rules, no deliveries or anything like that. And I had counseled them that these markets aren't really futures. Now, that was in the late 80s. At one time, the government that changed closed all their markets, so about 60 of them. They were all closed. Then in their place, they opened 3 new ones that dealt in agriculture only. And those are the ones that still exist today. And they are extremely well run, and they do enormous volume. The only thing negative about them is they're very internal. So it's only a Chinese audience they speak to, and the traders trade. There are Chinese traders, of course, and there's no interaction with the rest of the world. And I've been telling them for the last 10 years that until they let cross-order trading occur, you won't really know how good that market is or how strong it is or whether the prices really reflect the world pricing, which they don't always. And that's been my message and still is. But in the meantime, I also convinced them that they ought to have a financial market, because the finances where futures have gone. I don't know if you know, but the BIS reported last year that 81% of the futures markets worldwide are in finance. That's an incredible figure. And so they listened. I went through all the motions and held a symposium for them with inviting people like Myron Scholes and the like to speak about the advantage of a financial futures market to their economy. They liked it. And about 4 years ago, they instituted the CFEX, which is the Chinese financial futures market, which listed, at my advice, their Shanghai 300, which is called the CSI 300, and represents the stock market of China, which of course is very of great value to the public and to everyone in China. And now they had another instrument, which I convinced them would be helpful in case there was a bubble in the stock market. They would have a place to hedge some of the risk. They opened it about 4 years ago. I was honored to be the bell ringer, and I was the only round eye on the stage anyway. And everybody came, though. I mean, the whole world sent a representative, a whole world of futures. And that market has been the most successful market probably ever launched in terms of its volume from day one. Incredible. If you recall, when we open a market, even today, a new market, if we get a total of, 5,000 trades would be enormous. 1,000 is what we really shoot for on the opening day. Well, they had 50,000 their first day. So you had to know this is something else. And it was. It's been very, very successful. And now I'm continuing to advise them. They appointed me to the International Advisory Council of the CSRC, which is their regulatory arm. And that's once a year meeting. And that it was indicative of what they thought of me. They translated all my books into Chinese. Some of them are used in schools. And when I meet with the leaders on the private sector, it is really talking very much to someone here in America. That there is a little difference, except they know that they cannot do a cross-border trading yet, and they want to, and they feel they're ready to. And I think the government's going to move in that direction within the next, I'm going to guess, 2 years. And when that happens, they will finally be able to learn whether their markets are strong enough to compete or not. That's one of their concerns, of course, as it always is for new markets. But I think I have proved to them that if they use Globex as a mechanism for trading, around the clock even, Globex has done extremely well for the countries that have adopted it, whether it's Brazil or Mexico or Korea or Singapore for that matter. All of these markets use Globex in one fashion or other, and it's never been a reduction in their volume. It's always been an increase in their volume. So I think they're going to move in this direction. Now, having said all that, and I know I'm not making a speech for you, but having said all that, clearly the population in China does not have the human rights that we all enjoy in the United States. Most of the world doesn't enjoy as much of the human rights as it does in the U.S. still. And they have rules against things like standing on a soapbox and saying bad things about their government. You'll probably end in jail if you do that. So there are these restrictions, and I've even discussed them openly with many audiences. So I don't get arrested for saying so. Milton Friedman always used to say to me, if the economics create a middle class, then the middle class will demand human rights. And there's a very small middle class in China still. They've got the very rich, and they are very rich, those that are. And they got the very poor, and they are living, some of them, in dire poverty. So the middle class is still very, very small. But I am hopeful that Milton Friedman was right, and that once they build a middle class, they will have to concern themselves with a different setup of rules than they have presently. That's my speech.
So I had a chance to travel and speak in mainland China last year for about 2 weeks, and I share a lot of your experiences. And it does feel like talking to Americans, they're ready. And I think you're probably right. You just brought up a topic area, an individual that I plan to ask you about today. So I think maybe it's a perfect time to bring him up, and that's Milton Friedman. And I wonder if you might recall maybe the first time you met him, and perhaps recall maybe some of the fondest lessons that you had a chance to take from him, some of the things that you learned from him.
That too is a tall order. But when I first met Milton Friedman, I was still trying to gain credibility on the idea of launching financial futures, because the world thought I was a bit off my rocker, and that it, A, was a dumb idea, and B, it wouldn't work, and C, we would be the laughing stock of the world, since our destiny was pork bellies and butter. Well, I didn't believe that, and I was chairman of the exchange, of course, at the time. But the board, I was in my 30s, and I think the board was in their 130s. So we had different viewpoints, and they were the founders of the exchange still. They started their world in butter and eggs, and that's how it's supposed to be. And across the street was the real big brother, the Board of Trade. And what did he trade? He traded the grains, of course, very successfully. So clearly that's where the niche for futures lies. Well, I didn't believe that, and I thought my idea of launching, say, currency futures would lead us into finance. But currencies, I thought, were ripe, because I believed Bretton Woods was going to come apart because it was an antiquated fixed exchange rate system. So the guy I could go to, or at least thought I could go to, is Milton Friedman, who was a professor at the University of Chicago. We didn't know each other, but I suspected he knew who I was, and he did. And he offered to meet with me, but it was summer, and he said he's going to be in Vermont. That's his summer home, and would I mind meeting me for, say, breakfast or lunch at the Waldorf Astoria, and we could discuss whatever I wanted. Well, I accepted that invitation. We met at the Waldorf, and I said to him, well, the first thing I said is, please don't laugh. And he assured me he wouldn't laugh. And I told him that I had an idea of launching a financial contract in foreign exchange. And what did he think about that? Well, he embraced me, literally, and said, oh, my God, that's a wonderful idea. Do it. I was flabbergasted. I mean, this guy was in my world. He was the economic god, telling me that the idea was good. Holy mackerel! And so I said to him, I said, "Are you sure you're convinced of this? Because remember, agriculture is strictly. Futures are strictly in agriculture. We're talking about finance here." He said, "Of course, there's no reason it wouldn't be any different." I actually thought it would be better. So I said to him, nobody's going to believe me that you said that. He protested, just tell him I did. And I said, no, I got to have it in writing. Oh, he said, in writing? He then said, you want a feasibility study, is that it? I guess so, I said. He says, well, I'm a capitalist. I said, how much will that cost? He said, $7,500. Well, we shook hands. And while $7,500 was no small amount in 1971, which is when this conversation occurred, I don't know what the salary of a professor at the University of Chicago was, but I'm going to assume that $25,000 would have been a big sum. Maybe it wasn't even that high. So $7,500 was a good number. We agreed. He wrote the feasibility study, of course, and I launched Currency Futures on May 16, 1972, and it's been no stopping finance from then on.
As we're having this conversation, we're actually kind of starting with the current and working our way back, and I'll go even back before your meeting with Friedman. You had this maverick idea, and I'm curious if you can. I've seen some of where you went, and you were kind of thinking along the lines of evolution and diversity. But what spurred you? Financial futures. This did not exist. So, is there something that spurred you?
Well, there's many causes. The main one is that. If you recall, in the late 60s and in 1970, the Bretton Woods system, which was a fixed exchange rate system, was constantly going through devaluation and revaluation by big numbers because the world was changing, and the idea of fixing an exchange rate once a year and having that fixed for the rest of the year was ridiculous. Now that information was flowing the way it did in the late 60s, it wasn't like it was in the 40s when we were the only country in the world on its feet after the war. So it was clear to me that fixed exchange rate was going to bust. And then there would be this constant flow of information that would change the valuations of currencies moment to moment, maybe, or certainly day to day. And wouldn't that be great for a futures market? So that was certainly a key to my beliefs and key to the actual launching of currency futures. But there were other reasons as well. When I was, that I was a child who escaped with his parents from the Nazis, right?
Absolutely.
Okay. So in the travels, my father, who was a teacher, first and foremost, always, used to, it was a long long escape. It took about 2 years, and sometimes we would be under a given regime for a month, 2 months, 6 months. So when we were under the Lithuanian regime, my father showed me zloty, which is the Polish unit of trade, and asked me if I knew what that was, and I said, of course, that's a zloty. I was 7 years old at the time, but I knew that much. And he held up another coin, which was the lit, and I, of course, didn't know what that was. He said, it's the lit. It's the Lithuanian currency, unit of currency, and what do you think they're worth? So I ventured that they're worth the same. And he said, well, let's find out. And he took me to a bakery. And he asked for the baker to give him how much is a loaf of bread. The baker said something on the order of 1 lit. So my father said, fine, let's take the loaf of bread. And then he handed him a zloty. And the baker said, oh, no, 2 zlotys, 1 lit, 2 zlotys. Oh. And so there was a lesson in market economics you don't get very often, but here was a real lesson for me. And my father explained that the only way you can figure out how much currency is worth is in the marketplace. Never mind what the government tells you. The government said the zloty and the lit were identical. Well, that's not true. You saw it. Zloty was not worth as much as a lit in the marketplace, and that's the only way you can figure out the value of currency. Well, that lesson, I got to tell you, never left me, and it's one of the reasons that I believe so much in the market. And later, when I read all of Milton Friedman's works, of course, my father had not read those, I don't think, in Poland. When he was growing up in the 20s, I doubt it. But anyway, Milton was saying the same damn thing, and I believed it. So the combination of today's events, which were the fixed exchange rate system was doomed, my own history, and one more thing. I knew as chairman of the Merck, which was a backwater exchange of little value, really trading in some esoteric things like pork bellies, wasn't going to go very far. I was looking to diversify the exchange. That was the number one motivation that I became chairman. It was to diversify the marketplace. I didn't think an exchange with one product line, and at that time we were trading cattle, pork bellies, and hogs. And that's all a meat complex. And that's one line of trading. And I just thought that you had to diversify in case something went bad in one line, you had another line and another line. And so the breakthrough to my thinking in currencies was a combination of all these things.
It's fascinating. It is truly fascinating to be at that point where something terribly unique is going to happen that's going to change the world. But I want to continue to just take a step back, because I think my audience loves the idea. Look, we're talking about you meeting with the Chinese president, you having Milton Friedman as a friend ultimately, but you didn't start that way. I mean, you started with you and your family escaping Nazi-controlled Poland. I mean, you're escaping, going across Siberia through to Japan and making it to America.
That's right.
But as a young man with a law degree in hand, eventually, you wanted another job. And so your first understanding of futures, answering a want ad for Merrill Lynch, Pierce, Finner, and Bean, looking for a runner, that was your introduction. Why don't you explain that story about what you thought Merrill Lynch was?
I thought it was a law firm. Anyone with so many names tied together can't be anything but a law firm. That's how, listen, I was 20 years old. That's what I believed. And entering law school fit my schedule for that year. John Marshall Law School was that my first class was at 2 p.m, and here's a law firm seeking runners, probably to court, I thought, from 9 to 1. Well, that was perfect. So I applied, and when I was given where to go on Monday morning, of course, I saw that I thought I was in Alice in Wonderland because it certainly wasn't a law firm. But whatever it was exciting. And when I found out what the job of running would be, I took it. It paid $20 a week. And my boss, Joe Seeger, used to slip me another 20 at the end of the week. So it was unbelievably well paid in those days. And I loved it from the moment I walked in. I knew that this was something I really wanted to do. So I finished law school, of course, and even practiced for some 8 years. But I used to divide my attention between the market and the courtroom, and the market won out.
You decided, though, to buy a seat 15 months after you first answered that one ad for a runner.
How do you know all this?
What's that?
How do you know all this?
Well, I read your book.
Oh, okay. Yeah, I did decide that I wanted to be a member. Memberships were $3,000 then, and we had gone through such holy hell before I arrived because the Congress had voted against there being a onion market because the board of directors at that time had did so many illegal conflicts that you can't even imagine, and so they were supporting memberships at 3,000. So I thought if you had to support the market, maybe there's value here, and I told my father that I wanted to buy the membership and be a member. He made me promise that I would finish law school and practice law. He didn't say forever though, and I agreed that I would. And the man, it was probably I have no doubt one of the smartest people I ever met because he knew to run out of the Nazis' hands even before the Holocaust began, in real terms. So this is a smart guy. He had about $5,000 in the bank account. What teachers don't get very much money. And he lent me $3. Out of that $5, and boy, that's a measure of his understanding the world.
That's huge faith in you at that time, right?
Yeah. You know, I wanted to pay him back. He never would accept. So instead, when the IMM was launched in 1972, we were selling them for $10,000 a membership, right? And I bought one in his name and gave it to him as a way of repayment. So years later, when the IMM seat was selling for around $400,000, and I thought, I told my father, maybe it's time to take a profit on you. And he said, no way.
Oh, that's crazy. That's awesome. As a man who was at the Merck starting so early there in the 60s and seeing everything grow up, you had a chance to be around and see either up close, personal, from a distance, some of the best traders on the planet, many of them still today. Would you offer any just recollections? You could pick the name or pick the insight about some of the traders that you saw coming along while you were with the Merck.
Well, there were some very, very good traders that I ran into and befriended. One was actually at the Board of Trade. His name was Ralph Peters. And there was very little question in my mind that this guy was the best of the best. I mean, he took enormous positions, but he had a sense of the market, and he wasn't a scalper in the pits or anything like that. There were many that were very good, what we call scalpers. They buy and sell constantly during the course of the day and come out ahead a little bit, but it adds up. This guy was a position player of enormous sort, and it just simply that he understood markets and he understood the facts and the figures, and he was a fundamentalist. He wasn't a technician, and truly a remarkable guy. That I liked him very much, although he must have had some faults, but As a trader goes, I really admired him. I want to tell you, when I launched the Standard & Poor's contract in '82, the Standard & Poor's stock index contract made the mark, because that put us really on the map with Wall Street and everybody else. And that was my desire to launch that market. But I had a lot of competition. The main competition came from the New York Stock Exchange, which was going to launch the New York Stock Exchange index, and that was formidable. So I pulled out all the stops asking people to support it. And I, of course, met with Ralph Peters and said, look, we need volume. I need volume in this new entity. It's going to be launched in April. And I'm asking you to do as much trading as you possibly can in the Standard & Poor's contract when it's launched. I did that with every major trader. I even called Jimmy Kane at Bear Stearns. He guaranteed me he would support the Merc, and did. But Ralph Peters, so the market started, and the main thing was open interest. You know, that's how we measured whether a market is just daily trade and it doesn't leave anything in the market, or whether the open interest grows. And if the open interest is growing, then you know this market has a good destiny. Anyway, the market open interest was growing. And one day Ralph Peters came to my office on an appointment and showed me that he was long, now this is 1982, right? He was long 1,000 S&Ps. And that was a figure, I can't even tell you what that represented, 1,000 S&Ps. And surely he was spread somewhere is what I thought, you know. And this is 82. And I said, so where's the other side? Meaning, where's the spread? Oh, he says, I'm not spread, I'm bullish. Now, you think about where 82 was when the U.S. stock market was in 82. Unbelievable. And I don't know how long he held on to that, but he sure gave me support, and he must have made an unbelievable ton of money.
Hey, Leo, if you were thinking currency futures in the early 70s, you were surely thinking stock futures. What became that delay of nearly a decade to get stock futures out there?
You couldn't do it. It was against the reason, because in order to have stock index markets, you're trading an index, right? You can't deliver an index. You can't deliver 500 shares. It's hugely complex, and with dividends and you know, the dividing the stock, the number of things that happen in the stock market. So it was impossible. But I knew that if you didn't have to make delivery, if you didn't need physical delivery, then I could trade indexes, and they could be cash settled on the basis of what valuation in money. I went to, in 1980 and 81, I and our attorney Jerry Salzman went to the CFTC and met with Johnson. Phil Johnson was the chairman's name, and I told him that, you know, why do you need physical delivery? That's an old way to, you know, to bring a market to maturity. People don't use futures markets to gain the product. It's used as an insurance policy. That's all it really is, an insurance policy. An insurance policy, you don't want someone to deliver your house after it burned down. You want the money to build a new house. Yeah. And so if it's an insurance policy, surely we could settle it in cash rather than in physical delivery. Well, that argument held water. The CFTC approved cash delivery in 1981, and I launched the first product in indexing, which was the euro-dollar contract. That was an index product for short-term interest rates that are held in the world, and it became the biggest market we ever had. But at the same time, I had already negotiated with Standard & Poor's in 1980 for a license to trade their index, the S&P 500, which I thought was better than the Dow because it was a larger index. The Dow is 30 industrials, whereas this was 500, more representative of the stock market. And they gave me license. So I knew I was going to launch the euro dollars in 81 and the next year the stock market in 82. But it all depended on the CFTC giving us approval to do cash settlement. Otherwise, none of this could have happened. With cash settlement, the expansion of the marketplace in finance was sky high. There was no, whatever your imagination warranted and the market needed, you could do because you could cash settle.
Leo, it's fascinating stuff. I have one more thought, and maybe you could comment on it as long as you'd like, but just the notion of speculation. I mean, speculation has been at the heart of your career, and the free market, the true price winning out, and speculating. This is where it's at, and I think sometimes maybe as a society and a culture, we lose sight of the fact that how important speculation is, and it's not a bad thing. It's not a pejorative.
On the contrary, without speculation, you really can't get a market. Hedgers have one interest is to insure their product, and they use the market. So if there's 100 hedgers to come, the 100 hedgers will most likely do the same thing at the same regular interval. So who are they going to sell to if there's just hedgers when they want to sell their product for a hedge and insure the price? There's nobody on the other side. The other side is just other hedgers, and they're all trying to sell. And the only way you have a market is if somebody on the other side says, well, that price is pretty good, I'll buy it. But that guy is a speculator. He hasn't got anything to hedge. He's just trying to make a buck. With him on the other side, you now have a market. Our market, I used to know that in every successful market, we had about 60% speculators and 40% commercial. And commercial buyers and sellers, they go both ways too, because they sell and they buy back and they do all kinds of things. But they're usually doing the same thing at a different time, whereas speculators take the other side of these things often. And with speculators, you end up with a market. You can't end up with a market that's all speculators, because then there's no purpose to them. Then it really is just gambling, because there's no underlying economic need. You got to have an underlying need. But once you have that, you have to have speculators.
Fascinating stuff, Leo. I could ask you questions all day. I think you know that, so I can't keep you all day. Hey, for the audience out there, obviously people can quickly Google your name and find your website, find your Wikipedia entry. There's a ton of additional information that they can read up on, and I highly recommend Escape to the Futures. We did not really talk today about the early part of your life and making it from Poland, but it's just terribly fascinating, and it's not something. It's a journey that most of us that are younger these days, obviously, we don't have to make that journey.
Yeah, and that book's been translated in 7 languages.
Well, I highly recommend it. Escape to the Futures, audience. Hey, Leo, I appreciate you taking the time today, and hopefully maybe we can talk again in the future.
It was a pleasure. Thank you for all the kind and flattering remarks, Michael.
Thank you, Leo. Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.